street is even more bullish on Trump winning than the predictive markets are.
The most bullish for the dollar's a red wave.
Yields, I think, are moving higher based on the election.
To have a closely contested election would be very unsettling to the bond market.
I think inflation is due to notch higher, or at least stay stubbornly stuck where it is, no matter who wins.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Election day, a week today. From New York City this morning, good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday with equity futures on the bounce from yesterday. We're just about unchanged on the S&P 500. On the Nasdaq 100, we had a little bit more weight to this. We're up 0.1%. Get to the bond market and sit at the front end of the curve. The two-year yield is higher for 7 consecutive days. If we close higher for a 7th consecutive day, that is the longest run since May of 2023. On the calendar today, some important economic data. We kick things off with JOLTS, job openings a little bit later on this morning. Then after the closing bell, Alphabet reporting. The first of the Mag 7 reporting so far this week. Lisa, as for the economic data for JOLTS, I've heard this a few times already. This might be the last clean data point going into the Fed's meeting a week tomorrow.
The translation being it might take on outsized importance in terms of a market response because it is maybe a better guide than the headline number may be on Friday. I will just say it is incredibly notable that we've seen this rise in both 2-year and 10-year yields, even though oil prices have been declining. This has come with other factors, whether it's the Trump trade, whether it's something else with better economic data, unclear, but it is shocking to see that 10-year yields are up 68 basis points since the recent trough 2 days before the September Fed meeting.
I'm with you. Crude had its worst day of the year so far, down 6% yesterday, and yields crept higher by 4 basis points. I've heard it from you. I've heard it from Jim Bianco, Jim Reed, Bob Elliott. We're all looking at the same thing here. Why? And I'm hearing the T word quite a lot. This is from RBC. The market's syncing up with Trump again. Citi, Trump trades have rallied. Morgan Stanley add a GOP sweep to the list of goodies already discounted. Your thoughts on this in this market?
Well, so look, we're a week out, and already you have more than 50 million Americans going out and voting, according to the University of Florida's election lab. Why people maybe are thinking more about a Republican sweep? Because it is easier to get a Republican sweep than a Democratic sweep because of the Senate map. And we're going to talk to Jessica Taylor of the Cook Political Report. And there's 3 key races to watch. One, Nebraska. That is certainly becoming a little bit of a wild card. Wisconsin and Pennsylvania. These 2 Senate races were lean Democrat, and the Cook Political Report says they are now toss-ups. And we look at 538, 2 out of the 3 blue wall states, Wisconsin and Pennsylvania, are even, dead heat for the presidential race. New York Times this morning reporting Kamala Harris, that camp thinks they can hold the blue wall, while the Trump camp thinks they can easily pick off at least one of those states. It's really going to come down to these 3 key states, and everyone has their eyes on Pennsylvania.
Mike Wilson of Morgan Stanley has alluded to something similar, that maybe this playbook this time around won't be the same as the one back in 2016, because so much of a Trump win has already been discounted. And if you get a Harris win, then we're vulnerable to whipping the other way.
Yeah, he's talking about directionally some of the sector leadership might actually be somewhat in line with the Trump trade of 2016. But there is a completely different scenario, whether it's coming to the materials world, whether it's coming to how much has already been priced in, and whether it comes to the deficit that already is significantly higher at a time where inflation, remember, inflation was welcome back in 2016. An inflationary shock was thought of as a great thing to get us out of this disinflationary spiral. Well, what a difference 8 years makes.
I remember 8 years ago, we wanted more active fiscal policy. Do you remember that?
Thank
you.
Okay.
Backed away from that in the last 8 years, that's for sure, after the last 4 in particular. Equity futures on the S&P 500 just about positive at the moment. In the bond market, yields have been climbing once again this morning by a basis point or 2, very briefly, taking out 430 on a 10-year, 429.83. Coming up this hour, we'll catch up with Michael Shaoul of Ion Asset Management as the U.S. economy continues to beat expectations. John Lieber of Eurasia Group on Donald Trump's rising momentum, and Jay Bryson of Wells Fargo expecting a cooler labour market. We begin this hour with equity futures little changed and bond yields pushing through 3-month highs, going into a busy slate of economic data and Mag 7 earnings through the week. JOLTS job openings and consumer confidence due today, ahead of Alphabet earnings after the closing bell. Michael Shaoul of Ion Asset Management joins us now for more. Michael, good morning to you.
Good morning.
What do you make of the argument that we've already discounted a Trump presidency?
I think you have, to a fair degree. It's a big difference to 2016, where pre-election, every time Trump was ahead in the polls, the markets went down. So, we are set up for something quite different. At the same time, the market didn't really think it would have a Trump presidency and had no idea what it would actually mean. At the same time, I don't get the feeling that the election has been that important for the overall flows into the market. I think it's been very important for some very specific flows. I'm sure at the margins, yields are higher because of Trump trades. But I also think yields are higher because people went much too far in the other direction going into that September Fed meeting. And I think most of what we've seen in the backup in yields is the realization that the US economy is okay and the Fed is not going to be cutting rates by 150 to 200 basis points over the next 12 months.
So how big do you think the stakes are coming out of next week? Do you think it has the real potential to redefine the macro environment?
I think it has the potential to redefine the country. It feels like a very, very big election from a social perspective. I think you'll have a different America one way or the other. As far as the macro environment's concerned, I think there are limited tools available, even in the case of a sweep. I don't think it's easy to extend the budget deficit beyond where we are already. This already seems to be a reckless fiscal path that the country's on. And, my suspicion is whoever wins, I think they better hope for divided government. Otherwise, they're going to be disappointing a hell of a lot of their base going forwards.
But even if it's a sweep, and now the market's pricing in this red sweep, a lot of that has to do with the Senate. We are talking about, the former president is talking about using the Alien and Sedition Act of 1798. He's talking about mass tariffs. All of this he can do with executive orders. Wouldn't that have massive implications on the macroeconomic policy?
Yes, I do think tariff policy is the clearest big difference where I think you could see, Trump and Harris looking completely different. Again, I think there'll be limits to what can actually be done. There'll be practical limits. I think you'll see market pushback, corporate pushback. But I do think under Trump, his tariff policy, he feels, was relatively successful. I think it's notable that the Democrats did not unwind pretty much everything that he did. I think, I'm not saying, there's obviously big differences between the two of them. And yet, I think many of the big issues facing this country are going to be facing us no matter who takes charge next week.
True, especially when it comes to tariffs, and the Biden administration kept those tariffs on. Today, we have more news overnight about outbound investments when it comes to China. They definitely have, there's a bipartisan approach, I guess, in how you want to view China. But you said that when it comes to tariffs, the market pushback will be strong against what Trump is trying to do. So say he does come in and does 10% tariff ring around the United States, 60% on Chinese imports. What is the market reaction?
Oh, I think it would be quite negative. I think there would be, I think there would be concerns. I think
but enough for him to come out and rewind.
I think he has. Look, he's an interesting character. Sometimes he promises big and delivers small, and sometimes he doesn't say anything and then delivers. He's the trouble with Trump, and this is what we all experienced. Certainly between 2016 and the beginning of COVID, which was its own story, was trying to understand what he would actually do. Now, I saw the headline on Steve Schwartzman saying Trump understands more about what the job of president is. I think that's partially true, but he doesn't seem a terribly different person 8 years on.
I thought it was notable. You're talking about when we find out next week. I really have a question around that. Harley Bassman, who is the creator of the MOVE Index, which is the the implied volatility in bond yields, he talked about how there is the biggest potential volatility event from this election being baked into the bond market ever in his career, in data going back at least to 1988, saying that basically this market is pricing in an 18 basis point rate move in either direction on the days, not day, days immediately after the election. In this particular incident, are bonds the risk asset?
Well, I think you have to be careful. Volatility indexes show you what people are willing to pay for relatively short-term protection. So I do think the bond market is being used by people to protect portfolios. But you might have somebody who's got a really, really big pro-Trump trade on and a bond trade pushing against it, or somebody who's positioned in the opposite way. So I do think that volatility levels get pumped. Now, normally it's equity vol. This time it feels like the bond market has been used more by people wanting to put some kind of protection in their portfolio for how it performs between Tuesday of next week and Friday of next week. It's not quite the same as saying the move index is really, really high because everybody's afraid the Treasury market's going to fall apart. It matters, but it matters for a different reason.
When you came on a bit ago, you had just started in this new role, and we asked you how you're kind of thinking about weighting the different risks and what you're positioning for, and you didn't know. Are you more clear on kind of how to position in this uncertainty?
Look, I said when I was pushed, I hate being asked what I like or what I should do. I said precious metals were interesting 6 weeks ago. They've performed really well. I do think we are, we're in the beginning of this long story of fiscal discipline being reimposed on the US and other developed countries. So you hear more and more people talking about what are we going to do about the deficit, how are we going to deal with, the deficit. I think the very strong performance of gold and the beginnings of strong performance in silver are the signs of people moving into those markets partly to protect either corporate wealth or personal wealth. And I think that story survives no matter what happens next week. I have a hard time looking at our portfolio, understanding whether it wants Trump or Harris to come in. We have certain trades which I think have been the beneficiaries of Trump flows over the last month. And other parts of the portfolio probably would have moved the other way. To the extent we've got any exposure in China, I assume they'd rather see Harris came in. I think we'll pick up the pieces next week and decide which way to push it. But I think big picture, medium, longer term, certain trades like precious metals look interesting no matter who takes charge.
Gold up this morning, up more than 33% year to date. Michael, it's good to see you. Thank you, sir.
Thank you.
Michael Shaoul there of Iron Asset Management. Equity futures just rolling over as well, slightly negative just for a heartbeat on the S&P 500 with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Speaking of Trump trades, Bitcoin topped 71,000. That is its highest since June. It's being driven up by ETF inflows on the speculation of the U.S. election outcome. It is seen as a Trump trade to the Republican nominee's support for digital assets, with some predicting a rally beyond its March record high. Options traders, they are betting on Bitcoin reaching $80,000 by November, regardless of the election outcome. Apple's iPhone exports from India jumped by a third in the 6 months through September. People familiar with the matter tell us that the U.S. tech giants exported nearly $6 billion of India-made iPhones. That puts annual exports on track to surpass fiscal 2024. India is a crucial part of Apple's efforts to lessen its reliance on China, where risks have been growing alongside with Beijing's tensions between it and the U.S. Starbucks is threatening to fire staff if they don't return to the office 3 days a week. A memo seen by Bloomberg says that the coffee chain is implementing a standardized process from January to hold workers accountable. The move also comes less than 2 months after Brian Niccol took over as CEO. He told employees last month that they should work from wherever they need to in order to get the job done, but that he thought the place was usually the office. And that's your brief, John.
Hey, Danny, thank you. Every time I see a story like this, I'm shocked that they're not back in the office already.
Well, I love this also because Starbucks benefits from people being in the office and not making coffee at home. So it seems like a logical sort of home bias to try to get people back to the office.
You'd think. More from Danny in about 30 minutes' time. Equity futures just about unchanged on the S&P. Up next, Election Day, a week away.
Donald Trump spends full time trying to have Americans point their finger at each other.
The newest line from Kamala and her campaign is that everyone who isn't voting for her is a Nazi.
That conversation up next from New York City this morning. Good morning. Check out the bond market. Yield still climbing. Your 10-year up by 2 basis points. We're through 4:30. Equity futures just about unchanged on the S&P. Under surveillance this morning, Election Day, a week away.
Donald Trump spends full time trying to have Americans point their finger at each other. fans the fuel of hate and division, and that's why people are exhausted with him.
The newest line from Kamala and her campaign is that everyone who isn't voting for her is a Nazi. We're Nazis. I'm not a Nazi. I'm the opposite of a Nazi.
So here's the latest this morning. Donald Trump and Kamala Harris revving up their campaigns with only 1 week until Election Day. Donald Trump speaking at Mar-a-Lago, while Kamala Harris will deliver a closing argument speech at the site of the former president's January 6th rally in Washington, D.C. Bloomberg's Mike Shepard joins us now from the nation's capital. Mike, what do you make of the closing arguments?
This is her opportunity to speak to a national audience in much the same way that Donald Trump did on Sunday night in New York at Madison Square Garden. But in the vice president's case, she is going to be aiming that message specifically at key voting groups in the swing states. And we know which ones they are. And we know that she's going to be trying to speak specifically to women and to Republicans who might be sitting on the fence and wondering about whether they can cast their ballots for Donald Trump. And she's trying to highlight how the president has sowed divisiveness, including with remarks by some of the speakers who appeared at that rally at Madison Square Garden on Sunday. And Trump, for his part, is going to be trying to distance himself a little bit from that. And you heard in his remarks last night, trying to back away from accusations that those remarks indicate that he is, in Democrats' views, something of a Nazi, somebody who has espoused fascist viewpoints, as some of his former advisors have said. So we're at a critical moment here for both. Trump giving his remarks today in Pennsylvania, and then Harris tonight here in Washington in a very symbolic speech.
Shep, on Sunday, it was basically a part 2 of the RNC. Even this time was bigger in the sense that his wife, Melania Trump, actually spoke and introduced him, something she did not do at the RNC. Why is he giving a press conference as well this morning in Mar-a-Lago? Didn't he already give his closing argument?
Well, he did, except he is feeling the pinch of the blowback. This event in New York on Sunday didn't age quite the way they had hoped. They wanted to be able to leave New York with an aura of inevitability and, you know, the sense that they really had the race locked down. But instead, we saw that some of the language that we had heard, the racist, the misogynistic comments that we heard on Sunday, those risk undermining him with key voting blocs, not only women, as we just mentioned, but also with black voters and Latino voters that he has been trying to court for months. So we're going to see him today try to somehow extend an olive branch there and also put some of the blame for what we're seeing in the economy and elsewhere, and especially the border, back on Kamala Harris and the Biden administration.
Hey, Mike, good to catch up. Look out for that a little bit later. Mike Shepard there down in Washington, D.C. To continue the conversation, John Lieber of Eurasia Group joins us now. John, let's just start with the Harris campaign, accusing the former president of being a fascist, drawing parallels with Nazi rallies of decades ago. When you look at the polls, when you look at where things are at, a week away from the election, is any of it landing?
No, doesn't seem like it. I mean, nothing's moved in this race except for one big event, which was Joe Biden dropping out. And otherwise, it's been pretty steady. You have seen some movements among subgroups, particularly independent voters, which were shifting towards Harris and now moving back towards Trump. But you look at kind of any of the big set pieces of the campaign, the DNC, the RNC, even Trump's assassination attempt, you weren't seeing big movements, and you're not really seeing them in the closing days. In fact, one of the big markers of this campaign has been how incredibly steady it is and how most people's views of both of these candidates are totally baked in.
You know, John, I was thinking a lot about this last night, how a lot of this is culture wars kind of coming to the fore. It's the reason why we're seeing a massive gender gap. And on one side, you have the preeminence of cancel culture and sort of people who are really looking for potential issues. And then you have other people who say anything and it doesn't really register. That's why I think it's notable. Has this incident at Madison Square Garden broken through in a way that some of these other comments really haven't?
Well, I think the risk is that it's a really close election, and you've got about 500,000 Hispanic voters in Pennsylvania, many of whom are from Puerto Rican origin. So it's entirely possible that it doesn't take a big movement in the polls or even a big event that's going to be the thing that decides this election. I mean, it would be extremely ironic if it were a unfunny joke from a no-name comedian at an unnecessary rally in Manhattan that ended up costing Trump this election. But an election where the two candidates are going to be separated by as few as 10 or 20,000 votes, that is completely plausible in this election cycle, which is why these Puerto Rico comments and the other comments from the Manhattan rally are resonating so much and has Trump trying to do damage control.
John, what do you make, given how close this is, of the fires for the ballot boxes that we saw in Washington state? Some of the supposedly only 100 or a couple hundred different ballots were destroyed. But how much is there that risk going forward of this type of activity increasingly?
Yeah, I think there's a lot of risk of that. And you have to acknowledge that the Republicans have been convincing themselves for the last 4 years that the election was stolen. And in doing so, have basically studied some good techniques of how to try to steal an election. So I think that's a big factor. I mean, I don't think it's going to end up being a big factor here. But the thing that I think we should keep our eye on is people's trust in the system. So one of the problems with trying to tamper with the ballot box is you don't know whose ballots you're burning. So you can target different neighborhoods and have try to go after different demographic groups who you think have a higher propensity to vote one way or the other. I mean, Washington State is not going to vote for Trump. We know that. But I do think that this is going to be an issue where people lose faith in the process if they see that proper safeguards aren't in place to protect the sanctity of every single person's ballots. And that long term has a really negative effect on people's belief in the fairness of the system. And it's how you get a majority of Republicans believing the last election was stolen. And I think that's a very dangerous and disturbing trend.
Washington State's not going to vote for Trump, but where this ballot box was, it's in a congressional district where the Democrat incumbent is facing a very tough challenge from Republican. Just when you look at the map, John, right now the Harris campaign thinks they can hold the blue wall. The Trump camp thinks they can at least take one of those states. When you look at Wisconsin, Michigan, and Pennsylvania, which one is most ripe to flip?
I think, to me, it looks like Harris is the weakest in Michigan. She's got big problems with Arab American voters, and she's been a little bit weaker with white voters than she's been in other places. And so I think that's the place where the Trump team thinks they have probably the best opportunity. Pennsylvania is obviously the biggest and most important state and the one that is very, very close in the polls. Wisconsin seems like it's shaded a little bit towards Harris. So if I had to choose one, I would say Michigan is going to be the big battleground in this election.
It's interesting you chose Michigan because in Wisconsin and Pennsylvania, those are the two Senate races that are now looking more like coin tosses when they were lean Democrat. Do you think those Senate races could go red, but the top of the ticket and those states go blue?
Yeah, again, I mean, it doesn't take much in this cycle for you don't need a lot of split ticket voters for something like that to happen. I think all three of those races are competitive. In Wisconsin, Baldwin, and in Pennsylvania, Casey has the benefit of being incumbents, and incumbency brings high name recognition, and that does help incumbents survive even very good challengers in a decent year for the out party.
Hey, John, good to get your thoughts, as always. John Lieber there of Eurasia Group. Thank you, John. This should have been the envy of the Harris campaign. Donald Trump, the former president, in the Democrats' backyard with a sellout Madison Square Garden, with energy for a campaign we've never really seen before in this country. And yet, as John put it, overshadowed by an unfunny joke by a no-name comedian at an unnecessary rally in Manhattan.
And it's not the media that's really having the criticism here. Of course, they're going to critique it. But it's the fact that Republicans had to come out and denounce those comments. Why? There's a large swath of Puerto Rican voters in places like Pennsylvania, in Philadelphia, some 300,000 individuals of Hispanic descent. Half of those are Puerto Rican going to be voting. In places like Florida, why Senator Rick Scott had to come out. And this is something that can hurt any campaign when the margins are so thin, when you can win or lose a state by 10,000 votes.
The Trump campaign will be hoping the news cycle moves on and moves on quickly. We'll be moving on. Equity futures right now on the S&P 500, negative by 0.1%. Up next on a programme, pricing in election risk. We'll catch up with Dean Curnutt of Macro Risk Advisors on the volatility playbook with 1 week until election day. From New York City, futures negative in the bond market, taking out 430 on a US 10-year, yield to higher by 2 basis points. This is Bloomberg. Bouncing back from a week of losses in yesterday's session, equity futures on the S&P just slightly softer. We're negative by 0.05%. The Nasdaq 100 slightly positive. Bear in mind, the Nasdaq is not coming off the back of a week of losses. 7 weeks of gains on the Nasdaq 100, bucking the trend last week. Thank you, Tesla. A little bit later, Alphabet after the closing bell. We'll talk about that in a moment. The small caps on the Russell down by 1/3%. One to watch in the bond market, the front end of the curve. If we get a 7th consecutive day of climbing yields on a 2-year, that's the longest streak going back to May 2023. We are up marginally this morning. On a 2-year, 414. Lisa on a 10-year, taking out 430.
So Mark Rowan, who you spoke with of Apollo, was talking about how this is not an economy that's particularly landing. And he really does follow the Torsten Slok view of the world. And he, among other executives, his compatriots over in Riyadh, were talking about how likely it's unclear whether the Fed is actually going to cut by two 25 basis point rate cuts this year. There is a feeling they might have to rethink it based on how much better than expected the economic data has been coming out, even at a time where inflation has been coming down. So the reason why Thursday is going to be really interesting with core PCE.
The problem they've got, and the problem we've all got, is this debate won't be settled anytime soon. This data is going to be so noisy this month. If it's weak, we'll say it's not for cyclical reasons, it's hurricanes and strikes. And if it's strong, it must be really strong.
Well, and this really comes down to earnings, I think, because at a certain point, you have to understand how much there is this secular overlay of a technological investment cycle that's really boosting growth and boosting potential inflationary forces in a way, at least in the near term, that sort of defies the way it was pre-pandemic. In other words, we might be looking at a higher neutral rate. It's a fancy way of saying that, and I think people are grappling with that.
The estimate for payrolls on Friday in our survey still around 110. If you switch up the board, turn the page and get to the foreign exchange story, the euro just rolling over in the last 30 minutes or so into negative territory, holding on to 108. The dollar stronger for 4 consecutive weeks through last week, the longest run since June. The move in the bond market breathing some life back into the US dollar, which was left for dead only a few months ago when we were looking at 50 basis point rate cuts from the Fed and we had dollar bear after dollar bear on the program.
How much are people looking at the idea that the economic data has come in better than expected? And oh yeah, the people have been expecting that if Trump wins, and even if there's a red sweep, what will this do? It'll be the U.S.'s action and the rest of the world's problem, and the dollar will gain. And that's basically what you're seeing in the market. So how much is this tied to that belief, sort of how the market is positioning for Trump to win the election?
Euro dollar 108.09. Under surveillance this morning, Goldman Sachs CEO David Solomon touting the strength of the U.S. economy in an interview with Jemana over in Riyadh. Solomon saying his base case is for the U.S. to achieve a soft landing with a better outlook for deal making. He's basically putting some doubt on the moves from the Federal Reserve after the next 2 meetings, let's say. And we've heard that repeatedly from a lot of economists as well, that maybe the next 2 cuts might be easy. After that, we're kind of in no man's land.
Yeah, yesterday we heard that potentially there could be no rate cuts in the first half of next year, which would definitely be different than a market that is pricing in an additional 100 basis points of rate cuts. I am curious how much we are trying to figure out in real time what the new neutral rate is at a time where there is this sort of latent growth in the economy. Frankly, what I hear from executives is more of a bet on that than the election, more of a bet on that than even Fed policy.
He's sounding optimistic, though, about the trajectory of the U.S. economy, basically this idea of U.S. exceptionalism. His concern is things like in the Middle East. So kind of reiterated, Jonathan, what he said to you in May about how the U.S. is doing well and Goldman is doing well. When it comes to the election, he is excited for clarity. He said the markets want clarity. And then what he's also excited about, but on the edges, he talked really about this, the prospect of potentially a different environment for deal making, a.k.a. who will be leading the FTC. Now, if it's a Trump administration, we know how J.D. Vance feels about Lena Khan, but we do know how Donald Trump feels about deregulation. So likely she would not get another term under Donald Trump.
I'm pleased you said that because it's important. Corporate leadership wants clarity. What kind of deal can you actually close in America right now, given the pushback we've seen to things like Tapestry and Kroger as well?
Yeah, this is the reason why we see and hear about this backlog in potential M&A transactions that are waiting for some sort of clarity before they engage. I think, though, to Anne-Marie's point, I think she's spot on. It's very unclear whether, even if there is a change atop the nation, whether there'll be a change atop the FTC, given some of the recent comments.
That's one to watch, the latest out of Riyadh. What are we calling that? Davos in the desert? Is that right? OK. More on that over the next couple of days. Let's turn to Boeing, raising $21 billion in an expanded share sale. The plane maker looking to shore up the company's balance sheet and stave off a credit downgrade. A crippling labour strike now in its 7th week. The stock this morning, Lisa, down 1%.
You know, I was looking at some of the numbers, and this is a company that's burning around $4 billion in cash they're on track for the fourth quarter. They have been hemorrhaging something like $14 billion as a result of the strike, as a result of some of the questions around the safety of some of their jets. It's one thing to sort of raise cash to build up after this thing is done. It is another thing to get it done and to get some stability to really build off of, let alone understand what your business model really is going to be.
Sheila Cole of Jefferies came on the programme a month ago and said this would be 6 weeks. After 6 weeks, basically once you calculate the pay increase offset by what they're not getting paid, these guys are going to come back to the job. They're not coming back to the job.
Which raises this question of what it will take to get it done, because they got an offer for a pretty significant pay raise. The White House said, come on, guys, try to get it together. This is going to be important for us. And still, we're left here with them burning cash and raising money to begin the build after this is over. Well, we don't have a sense of when that could be.
Tens of millions of dollars every single day as these workers remain on the picket line. It's amazing they were able to get this deal done before they were able to get the workers back. And what's so interesting, and I think why everyone was so shocked that that last deal did not go through, is because at what point are these workers going to say, I need to get paid, and also they are now no longer receiving health benefits? That is a big hit to individuals.
That's the latest on Boeing. This is the latest on Ford, lowering its full-year earnings forecast due to warranty costs and hurricane disruptions. The outlook making a stark difference to GM, which raised its full-year profit forecast for the third time this year. That stock is down in the pre-market by 6%. And what a stark contrast over the last week. GM, pretty decent. Tesla, knocked it out of the park. Ford, a struggle.
Well, Tom Narayan yesterday said that they have a similar issue to Volkswagen in terms of the backlog, or Stellantis, excuse me, was the backlog of some of the inventories. And a real question of what is the big distinguishing feature? Is it just product mix? Is it a question of how much they devoted their business to electric vehicles and how much that's still burning cash? Some real questions about the distinguishing features of the successors versus the successful auto players versus those that are flat in their backs.
What took me with Ford yesterday is they said, we've taken costs out. We are trying to cut costs. They did remove $2 billion in materials and freight and other things, but they said we are not cutting as quickly as our competitors. Everyone in the auto industry right now is also trying to cut costs.
Ford getting hammered in the pre-market. More on that a little bit later this morning. Let's turn to the election, just 1 week away. Dean Curnutt of Macro Risk Advisors writing the post-election vol levels are extremely high relative to the recent movement in assets. The post-event earnings election Fed CPI referendum playbook for volatility is that it heads lower once the information is out. Dean joins us now for more. Dean, welcome to the programme. What does that very simple observation mean for what our approach should be to event risk in the next week?
Yeah, I think right now the equity market's pricing implied volatility as the catastrophe bond market would price before an event. In other words, it can be sunny day after day before a Milton is coming, but you know it's coming. And so you sort of have to brace for it. Right now, the market's not moving very much at all. You've got 1 month realized volatility in the S&P at about 9. That's not enough to scare anybody, into hedging. It's a really difficult situation because you've got something on the calendar that's consequential. And as you were referencing before, Harley Bassman's MOVE Index really prices this potential of a gigantic move in bonds, especially. And that's a vol risk premium, as we like to call it. It's basically the spread between implied and realized. That's across assets, that's equities, that's bonds. You see it in certain foreign exchange pairs as well. You also see it around the world. So the U.S. is basically exporting its election uncertainty around the globe. The playbook historically, I've studied this quite a bit through events like Brexit, events like the 2020 election, all of which are different than the current financial climate. But the playbook is that into the event, vol is very sticky, hedging costs are very high. And then once the information is out, volatility comes down. And so it poses specific and interesting challenges for hedgers, because when you hedge, you're effectively betting that the market could move in an unwelcome way, but you have to also try to think forward as to how well your hedge premium will hold post the event. And history tells us that it doesn't hold all that well post the event.
Dean, there's a lot to unpack there, but one key phrase: once the information is out. Is there a risk this time around compared to, say, 2020, 2016, that it might take a long time before we actually get said information?
It's a great point. I've been really thinking through these betting sites and trying to understand whether it's the whale, as you guys have reported on, a couple of folks with some capital moving the odds in Trump's direction, or is there real marginal information content that we should pay attention to? I think most would say that if Trump wins, that the challenges will be, considerably less from the Democratic side. Who knows? Maybe the black swan is that the Dems will really challenge this as well. But Jonathan, I think one of the things we're supposed to really focus on as equity investors is the bond market. I'm very troubled by the 70-odd basis point increase in 10-year yields post the Fed ease in September. That's just not something we would typically expect. So if the goal for Fed policy is to ease financial conditions, at least that part of it, and that's a main part of financing costs, for companies, for mortgages, and so forth, it's not working. And what that MOVE index is telling us is just a significant amount of uncertainty in the risk-free asset class. And what we've learned in the last couple of years is that equities can succumb to higher bond yields. The market is bracing for an outcome in which bond yields, go up and stay up. And I think that's really a risk as we talk about quarterly refunding and this just endless supply of capital that the U.S. needs to run itself.
Dean, I want to understand what the argument that you're making a little bit more. There's this question around the 70 basis point increase that we've seen in 10-year yields since September 16th, 2 days before the Fed meeting, and a question of whether this is a commentary on the Fed cutting too early or igniting some optimism about growth with a more or less restrictive Fed policy. And then there's a question of how much this is simply a reflection of bonds as the risk asset at a time of incredible uncertainty in the U.S. political sphere. I'm just wondering, from your vantage point, which of these two scenarios are you seeing as the more likely reality?
Yeah, I think there's almost three scenarios. One, you might map higher bond yields versus the increasing odds of Trump on betting sites like Polymarket. Second, you can point to better economic data, Citibank economic surprise indices going up in concert. And then the last one is just perhaps the world has had enough with U.S. debt. Obviously, we're still the reserve asset. That's not going away anytime soon. So we should respect that. We should also respect the history of market prices, even for liquid assets like the Treasury market. There is the potential that prices just gap out. We saw, I think it was last August of 2023, that is, we had that bear steepening event. The market basically said, in some ways, no mas for the additional supply that was coming. And I just feel like we push up against that without a real credible discussion around deficit reduction. Neither candidate has really expressed any interest at all in deficit reduction. So I kind of come out of this, Lisa, with the idea that there is an opportunity for investors to hedge. The S&P has got to be the best benchmark in the entire world. Over the last calendar year, it's up 41%. With 12 realized volatility. This is just an unbelievable Sharpe ratio. So it's almost impossible not to be invested almost fully. It's a very difficult benchmark to beat. And so you have an opportunity to take some of those gains and put it towards hedging trades, not ones that break the bank, but ones that can hedge you for, a modest slide down post-election in the market.
Dean, just quickly here, you talked about the MOVE index, Harley Bassman, talking about how right now it's implying about an 18 basis point move in either direction for a benchmark yields. I'm just wondering, based on the correlation that you're seeing across assets, could a move like that, given some of the potential lingering uncertainties, really trigger that decline, that gapping out in prices, not just in bonds, but also elsewhere in equities?
Yeah, we have some experience, right? We saw the joint drawdown in stock and bond prices in 2022. Some would say it was a controlled equity drawdown. But, up here at 430, maybe on our way to 450, we've got to keep a close eye on it. At some point, the stock market is just not going to be satisfied with higher bond yields and what they potentially imply for, choking off of economic growth.
You wonder how close we are to that moment. 4:30 on a 10-year. Dean, appreciate it, sir, as always. Dean Curnutt there of Macro Risk Advisors. Equity futures on the S&P 500 negative by close to 0.1%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of HSBC trading higher by 3.7% in the London trade. It announced a fresh multi-billion-dollar stock buyback and reported better than expected earnings. Those results driven by its wealth arm, which benefited from higher private banking volumes in Asia. Just days ago, HSBC unveiled a major overhaul of its business to merge its global commercial and investment banking units. The top prosecutor in Philadelphia is suing Elon Musk and his Trump super PAC. District Attorney Larry Krasner says that Musk's daily $1 million giveaway is an illegal scheme to influence the election. The giveaway, which is already under scrutiny by the Justice Department, purports to randomly reward voters in 7 swing states who sign a petition from the PAC. Musk's allies have argued that the giveaway awards people for signing a petition, not for supporting Trump. The Dodgers are on the brink of their 8th World Series title after sadly beating the Yankees 4-2 in Game 3. A first-inning home run by Freddie Freeman puts the Dodgers up early, and they never looked back. The Yankees were hoping for a boost from their offense, but only managed 5 hits, with slugger Aaron Judge continuing his playoff slump. The Dodgers are looking for the first World Series sweep since 2012, while the Yankees will try to become the first team in history to come back from a 3-0 deficit. And that's your brief, John.
Danny, thank you. Tough evening for New York sports. The Knicks, the Giants, and the Yankees as well. Is Judge going to turn up?
It's a crime. The Judge needs to turn up. I finally know what it feels like to be a Mets fan.
Really?
All this adversity.
Gratuitous kind of day.
All this adversity, you just got to believe.
Honestly, I was just going to say, I was hoping for a good game and a good series, and it's unfortunate that the Yankees haven't been able to rise to the occasion.
That's so nice of you, Lisa.
You can continue this in the commercial break. Up next on the programme, separating the signal from the noise.
For payrolls, you probably will see a significant impact from the hurricanes, but the Fed's just going to, and markets should also just look through that and see what's going on apart from those areas.
That conversation up next, live from New York. You're watching Bloomberg TV. This just in from Barclays. Investors confronted with one of the most pivotal weeks in markets this year. I would say the last few years. A big week coming up for financial markets worldwide. Equity futures on the S&P just about unchanged, and the bond market yields a little bit higher earlier on in the session through 4.30 for the first time since July. 429.42. Under surveillance this morning, separating the signal from the noise.
You know that jobless claims did pick up a little bit a couple of weeks ago, and that was very clearly the effect of the first hurricane that hit the southeast. 2 weeks later, we had the second hurricane. For payrolls, you probably will see a significant impact from the hurricanes, but the Fed's just going to, and markets should also just look through that and see what's going on apart from those areas.
So here's the latest. Investors looking to work through a noisy jobs report. The median estimate coming in at 110K among a wide range of estimates. Jay Bryson of Wells Fargo anticipating 75K and writing, it will be difficult to get a clean read from the report. The ongoing strike at Boeing has sidelined 33,000 union workers. In addition, payrolls are likely to be depressed from the devastation caused by hurricanes Helene and Milton, the latter of which made landfall during the survey week. Jay joins us now for more. Jay, welcome to the programme. Let's kind of try and break this down. When you go through the drag, how much is going to be union strikes? How much is going to be hurricanes? And how will we get a clean read on what is and what isn't cyclical weakness?
So, John, to your last point, it's going to be difficult to get a clean read on the cyclical weakness. But, you know, just to kind of level set here. So we know 33,000 people from Boeing are out on strike. There's probably a few thousand people who are not unionized who are furloughed who will also be affected by that. And then, you know, if you look at, say, continuing claims of the survey week, they were up about 30,000 from the week before. So these would be people who are showing up from Hurricane Helene in the mountains of North North Carolina. And then initial jobless claims also remained a little bit elevated this survey week. This is probably people from Milton. So the way we're thinking about it is your underlying run rate, we believe, is somewhere around 150, 160. You knock off, let's call it 80,000 or so from those two different events there. And that's how we come up with our number of 75,000. But there's going to be a lot of uncertainty here. And it's going to be, as you'd say, difficult to get a clean read on the signal and the noise.
Jay, how much are you focusing then on the unemployment rate as sort of the cleanest among dirty data points?
Yeah, so that's going to bump up too a little bit, Lisa. So we were at, I think it was 4.05. I mean, it was almost a 4. We would expect that to go up to 4.1. Now, if that shoots up to 4.4, I mean, then you have to start digging into it. Something going on with the labor market there that's causing that. What's causing all of that. So it's going to be a little bit difficult to get kind of a clean read there as well. But again, I think most of this stuff is temporary. When you look at all the other indicators out there in the economy, you wouldn't expect the labor market to be falling apart right now.
What I find fascinating is how much the bias in markets has shifted. Back in the summer, we were expecting the strength, and then that weaker than expected jobs market dropped, and boom, that was the last time we saw the levels that we're currently seeing on 10-year Treasury yields. How much is this a market biased towards strength? And that if actually these numbers come in better than expected, suddenly you see a bigger reaction than the other side?
Yeah, so, if they do come in better than expected, I mean, obviously that's showing you the underlying strength of the U.S. economy. Now, we're a little bit skeptical about the strength of the last month, the 254,000 jobs. It seemed like, education and healthcare hiring was very strong. I mean, it's been strong, but it was super strong last month. The same thing goes for leisure and hospitality. So I wouldn't expect, I would expect to see some sort of payback going on there. But, if you don't get payback there, if you get 2 consecutive months of really strong hiring in those two particular sectors, then I think you got to look at that and you say, wow, the U.S. economy is a lot stronger than we believe right now.
So, Jay, how big do you think the revision could be for the September print?
Well, we don't really factor in the September print too much at this point. It's difficult to know because that's been swinging around a lot lately. Obviously, if there is a downward revision to that, then that obviously tells you something there. But I think the main focus here obviously is going to be on the October sorts of prints, and that's again where we expect to see some of that weakness.
Jay, is there any kind of print that would stop this Fed from cutting interest rates a week tomorrow?
From cutting interest rates a week tomorrow. Yeah, I mean, John, I think if you are, let's say you get, for argument's sake, 150,000 sort of number, but you have big decline in manufacturing because of the Boeing strike, and you have big decline in some of the other sorts of sectors around there, you still got 150,000 sort of print, 150, 175, something like that. Maybe the market starts to price out the probability that the Fed maybe they wait in November and push it back off to December.
Interesting. Jay, thank you, sir. Jay Bryson there of Wells Fargo. That meeting begins a week tomorrow, concludes, of course, next Thursday at the Federal Reserve. Just a shift because of the election week. The range of estimates in our survey, 110 is the median. -10 is the low. That comes from Bloomberg Economics. The high is 180. Comes from Steve Rasciuto over at Mizuho.
I would argue that if you see an increase in the quits rate from Digital's report that we get later today, if we get higher than expected core PCE on Thursday, and then an unemployment rate that actually drops in any kind of meaningful way on Friday, you could set yourself up for a real messy Fed meeting next week.
That would be quite a mix for the Federal Reserve, that's for sure. This conversation will continue. We'll catch up with Lisa Shalett of Morgan Stanley Wealth Management in just a moment. We'll speak to Jessica Taylor of the Cook Political Report, Mandeep Singh of Bloomberg Intelligence, and former World Bank President David Malpass. The second hour of Bloomberg Surveillance just around the corner, with equity futures on the S&P 500 just about unchanged. From New York, this is Bloomberg.
There's really no macro theme that's driving markets.
I think we have to be concerned that a slowdown could be coming.
The bond vigilantes are definitely mounting up.
The solid growth story continues to be an underlying part of this Fed rate cut cycle.
The next couple of cuts, I think, are baked in, and I think that's justified.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now with equity futures on the S&P 500 just about unchanged. Likewise on the Nasdaq 100. Allow me to set up the next week. Let's start with the earnings. Today, after the closing bell, we'll hear from Alphabet. Tomorrow, Microsoft and Meta. Thursday, Amazon and Apple. Friday, the payrolls report. A week today, an election in the United States of America. 2 days later, a Federal Reserve decision. What a stacked week we've got coming up. One of the biggest weeks for years in financial markets worldwide.
Pretty much every catalyst for uncertainty in markets is coming to the fore with some sort of maybe resolution. We're going to get a Fed decision when they're widely considered to cut by 25 basis points. Will they, based on the data? Then, of course, the election. A question here of how much of a relief rally we're really being set up for, given the extremity of just how much uncertainty is baked into the market. I love these notes. Is this exciting? Is this anticipation? Or is this just holding your breath until we finally have an answer?
Well, according to Dean Curnutt, it's a bit of angst. And what the U.S. is exporting right now is that election anxiety to global markets around the world. When you look at the election 1 week out from now, the market is pricing in a Trump rally. There is this idea, though, of potentially this event. Remember, Republicans were feeling this excited during the midterms of 2022. And Libby Cantrell at PIMCO says that, yes, if the pollsters right now are underestimating what we've seen in the past for the support the former president has, then he wins. But what if they're underestimating like they did in 2012 with Obama, and they're underestimating potentially some of these younger voters, these first-time registered voters, many women that could come out and vote for Harris? How is that market going to recalibrate some of this Trump trade they've already baked in?
Well, we know what this market's doing right now. It's leaning into a long dollar, short bonds, long U.S. equities versus rest of the world position. How vulnerable are those trades into next week?
Honestly, this is one of the biggest questions that I see being raised by every single different house. And everyone comes up with a slightly different answer. How much this time is different. Mike Wilson over at Morgan Stanley talking about how the positioning generally has a sort of 2016 playbook, but is different in a couple of different ways. And he points out, and I think that we keep coming back to this is an election where Donald Trump is actually the favored candidate. That was the opposite going into the last election in 2016 when he won. So how much has this been baked in versus some of the uncertainty around what that even will mean?
That's the week ahead. We've got to deal with some earnings through the next 12 hours or so. We've got numbers from Google coming after the closing bell. McDonald's this morning, third quarter comp sales coming in at negative 1.5%. The estimate negative 0.67. Revenue for McDonald's, $6.87 billion. The estimate 6.81. Now, this is for the third quarter. We know that things are going to get a little bit more difficult in 4Q, given the difficulties they've had in the last week.
The issue for them is the international markets also. Yes, we're going to have U.S. issues. U.S. was the strong point, but now there's this question about E. coli and onions, and they're pulling quarter pounders, and that's going to be a problem. But they already are facing a lot of pressure in international markets, such as France, China, UK, Middle East, and this comes with protests. We saw the same kind of trend with Starbucks also facing some of that pushback. So some of these consumer international companies, how much are they going to feel the brunt of some of the disgruntlement with the United States outside of the shores?
Stock is down in the pre-market by 0.6%. Equity futures on the S&P just about unchanged. Want to take your attention, just draw your attention away from stocks for a moment and go to the bond market. The 10-year went through 430 this morning. The 2-year yield is higher for 7 consecutive sessions. That's the longest run since May 2023. We're talking about a 50 to 60 basis point plus move since this Federal Reserve cut interest rates.
68 basis points since September 16th on the 10-year yield. It is just shocking. And Dean Curnutt saying he thinks that people haven't made enough of this, that we've been so consumed by the election, by earnings, by other developments. There is a big question why. Is this because people do expect that the Fed is maybe cutting too much too soon? Or is this really a commentary on Trump? Or is this just simply that the U.S. economy is doing just fine and the new neutral rate is far higher than a lot of people used to think?
Can I suggest that Dean might have been watching the wrong news channel if he thinks we've been ignoring the bond market?
Fair
There's
point.
such a big, heavy flavour to this programme of fixed income, isn't there?
We could talk about auctions. They were not that great yesterday.
They were 2s and 5s, right?
Yeah, there were 2s and 5s. Today's we've got $44 billion of 7-year notes. Watch this space. I know I keep saying it, but it's actually getting more interesting because the tail that you're seeing on these really expresses some of the hesitance people have.
Is that enough bond chat?
No, never enough.
OK. Coming up this hour, Lisa Shalett of Morgan Stanley. As markets bounce back from last week's losses, Mandeep Singh of Bloomberg Intelligence previewing earnings from Alphabet. And we'll speak to former World Bank President David Malpass on Trump's economic policies. We begin this hour with stocks inching higher ahead of Google earnings. Lisa Shalett of Morgan Stanley writing the following. Markets have been extremely active over the past month as traders have juiced up the already ebullient scenario baked into equity valuations, adding improved odds of a Republican sweep to the list of goodies Already discounted. Lisa joins us now for more. Lisa, that's quite a quote. Good morning to you.
Good morning.
Are you suggesting this market's gone a little bit too far? Are things stretched?
Absolutely. I mean, we've been talking about for a while that on a valuation basis, this is a very expensive market on very ambitious earnings expectations. Let's just take a step back and think about what companies have reported. All right. If you look at the 12-month trailing earnings for the quarter ended June 30th, year over year, S&P 500 profits, including the Mag 7, were growing at about 5% year over year. In the quarter so far, what's been reported, and the Mag 7 haven't all reported yet, we're up 3%. The expectation for full year 2024 is we're going to get to a year over year compare up 9-10%, and then next year we're going to accelerate to 15%. So these are ambitious reacceleration numbers. And so, when we think about what's baked in and why we said there's a lot of goodies here, there's a view that we're going to get that reacceleration. It's going to be based on margin expansion, profit margins that are higher, but it's going to be so-called immaculate. We're not going to cut jobs to get there, which means, you've got to get productivity gains. And with all of this wonderful news happening, the Fed's going to keep cheerleading from the sides and cut, 25 bips a quarter at least. And then the latest is, all goes well. We get a red sweep in Washington. There is no more regulation. We get goodies like tax cuts.
No more taxes either, apparently.
And the world is a wonderful place. And so I guess, from where we sit, we just look at risk premiums. And so, as Lisa was just talking about the importance of this move in the Treasury markets, why are stocks shrugging it off? Right? I mean, typically this kind of move on the long end of the curve, particularly as underlying real rates approach 2%, which historically has been that obstacle for stock valuations, I think it's a bit dangerous for the stock market right here to be shrugging this off. This is a significant move. We've seen moves in the real rate, in inflation expectations, in term premiums, in auction performance. And so I'm very focused on watching these moves in the yields.
And the bond auctions, which is the reason why we will always welcome you on this show. So there's a question here about whether yields rising for the right reasons will actually be supportive to the equity market. And that's been an argument that a lot of people have made, and we've gone over quite a bit on this show. And there's a question of why you think that the yield rise that we're seeing right now is for the wrong reasons, or if it doesn't matter. It has breached that threshold where it needs to be something that stock investors start to pay attention to.
Look, I think that the bond market has this right. I do think real growth has been better. I am in the camp that says inflation expectations and the potential for an inflation boomerang next year is actually rising, especially if you bake in the part of the story about a red sweep. You don't get the red sweep with, all the goodies, but none of the collateral damage, which, as we know, tariffs and closed borders could be inflationary. I do think that the bond market is anchoring on, some hypotheses that's very anchored in the data. And I do think that the stock market is going to have to wake up and pay attention at some point.
So what do you do with that? I mean, do you just sort of go into gold and go into a bunker and hope for the best?
So what we're doing is we're really focusing on value and diversification. We're saying valuation in this market matters. So we're playing in the parts of the stock market that are somewhat cheaper, quite frankly. And so that has included some of the value cohort. It's included financials. It's included a handful of industrials, a handful of healthcare stocks. And that's really been our approach, is to say, let's even it out. Let's not take very big bets here and aim for some diversification.
Financials is a Trump bet, and yet you're saying it's actually a very different bet.
I thank you for pointing that out. Yeah, our preference for financials is not premised necessarily on some big deregulatory push. We think, that Basel II endgame easing of those capital requirements is going to happen regardless. We think that that's already, kind of been signaled by regulators. What has us excited about financials is not just the potential for cost cutting and operating leverage, but the capital markets activity really looks like it's going to come back over the next 2 years. as financial sponsors and the private equity guys finally get off the sidelines with these kind of market valuations and start transacting and doing deals.
Lisa, with the red sweep, you get the goodies along with some of the potentially the bad things that can hurt the financial markets. But what if it's not? What if the polling and the betting markets are underestimating the support Kamala Harris and some of these Democrats have with issues like abortion? How are you going to think about the next few years?
Yeah, so look, I think that there's, a Harris win at this point. I do think markets would be surprised. I do think we get somewhere between, a 2 and 5% pullback on that, because I do think that there's been, some pretty big rotation. But I think you get a lot of status quo type moves, right? I think we continue to get a continuation of the fiscal stimulus programs that we saw under the Biden administration. But we don't get necessarily, some of the issues and the inflation threats. So we continue maybe on this soft landing trajectory as opposed to this no landing trajectory. So I think the bond market comes back in as well.
But so you think the bond market comes back in?
I think yields come back in.
Even
and that's
with all that fiscal spending?
Yeah. I do, because her plans, if you actually do the analysis, and our team has done it, fiscal deficits under her current plan are going to run about half what he's proposed so far.
So hard to game this out. If you think about 2016, and we always go back to this, Trump was bearish for markets.
Yeah.
Up until the night of the election, and then we woke up 2, 3, 4 a.m. in the morning, and all of a sudden it was bullish. We go to 2020, throw the scenarios out the window. We got the vaccine efficacy data in November of 2020. Everyone seems to have forgotten about that. It had nothing to do with the election at all. And markets, Lisa, absolutely ripped that month.
Yeah, so here's the question. How much is it the setup going in versus the actual candidate themselves? And this time around, and we've talked about this, if he can implement the tariffs, but he can't get rid of some of the regulations and the taxes unilaterally in the same speed, does that dissonance change the reaction function of markets?
Lisa, this was a clinic. It's good to see you. Appreciate it as always. Thank you for coming in. Lisa Shalett there of Morgan Stanley, Wealth Management. Equities just a little bit softer here. We're down a little more than 1/10% on the S&P with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. McDonald's reported third quarter sales that missed estimates. Shares down nearly 2%. Had weakness in international markets. The U.S., though, was a bright spot, growth of 0.3%, more than expected. Analysts and investors are already, though, looking ahead to the fourth quarter, trying to assess the impact of an E. coli outbreak linked to Quarter Pounders. Apple has started rolling out its first set of Apple Intelligence features alongside a new iMac desktop that has an AI-focused processor. The AI software is now available for iPhone, iPad, and Mac. Although Apple previewed a broader set of capabilities in June, some of the most anticipated features that include a ChatGPT integration, those are not arriving until December. Amazon founder Jeff Bezos is defending his decision to block the Washington Post from endorsing Kamala Harris. The Post owner says that ending endorsements address a credibility gap in the media industry and denied that there was any sort of quid pro quo with Trump. In an essay published on the Post website, Bezos wrote that endorsements create a perception of bias and regretted the timing of the decision. And that's your brief, John.
Danny, thank you. There is a deep irony about this moment in news media that the accusation of bias is leveled at people who want to drop endorsements, not the people who want to continue them. I think it says a lot about the people complaining about what they really think about this. It's not about being neutral. It's not about endorsing. It's about endorsing a particular candidate that really matters here.
Well, I think the issue that Jeff Bezos is facing is that CNN was reporting that the CEO, Jassy, of Amazon had calls with the Trump camp, that Blue Origin met with Trump. So he came out because of this criticism and had to say, I have to be clear, there's no quid pro quo. Also, what I found interesting, Jeff Bezos says our profession, writing in this opinion piece. I didn't know he was a journalist.
He's one of us. Up next on the programme, it's not really. Closing arguments on the campaign trail.
On day one, if I'm elected President of the United States, which I fully intend to be, I will be working on behalf of the American people on my to-do list.
Are you better off now than you were 4 years ago?
That conversation up next from New York. Good morning. Equity futures on the S&P 500 shaping up as follows. Here in New York City, futures down by almost 0.1%. Bond yields higher by a single basis point. Let's round it up, 430 on a 10-year. Under surveillance this morning, closing arguments on the campaign trail.
If he were elected on day one, he's going to be sitting in the Oval Office working on his enemies list. On day one, if I'm elected President of the United States, which I fully intend to be, I will be working on behalf of the American people on my to-do list.
And I'd like to begin by asking a very simple question. Are you better off now than you were 4 years ago?
So here's the latest. Kamala Harris making closing arguments in the nation's capital later on today, just hours after Trump speaks at Mar-a-Lago later this morning. The Cook Political Report writing Trump's closing argument, his campaign says, is this: Harris broke it, Trump will fix it. And yet, even with all these advantages, the race remains locked in a dead heat. The reason for this, of course, is Trump himself. The Cook Political Report's Jessica Taylor joins us now for more. Jessica, welcome to the programme.
Thank you.
It's good to see you in person.
Yes.
There is this stat in your research, and I'm going to share it with our audience. There is no Trump policy that comes without his polarising behaviour, style and approach. In the September Cook Political Report Swing State Project poll, just 34% of voters said they liked Trump's policies and his leadership style. How much of a problem is that for the former president?
I mean, I think that if this were sort of a generic Republican, this race would probably be over. It's voters have to make a choice of, okay, you liked where the economy was under Trump, but you get all of the rest of this baggage that comes with him. So that's where we're seeing Harris's closing message. You know, he's an authoritarian. He's a fascist. This is the chaos trying to remind them of people. And I think some of the things that came out of that, Madison Square Garden rally, he's having to answer for them today. He's going to Pennsylvania, Allentown, where there is a large Puerto Rican Hispanic population. And that is now the story in this final week before the race. It's not focusing on, how he would be a change. He's trying to make it a focus on how he would be a change from a Biden-Harris administration. But Harris and Democrats are arguing, yes, but he was a change, and you're going to get all of this chaos. You're going to get all of this sort of insanity back again.
Jessica, are you seeing anything in the polls that Trump is going to be able to go past that ceiling that he's basically been capped at?
Yeah, this is the real question, and this is why, I think the polls, I think that's the thing at the back of our head, is that the polls were wrong in 2016, they were wrong in 2020, but they're still capturing about where he was at. They sort of this 47, 48%, and that's what we haven't seen. We really haven't seen him grow his coalition. So the question is, I think with these undecided voters, do they sort of go over to him? Do they stay home? Does Harris get them in her coalition? I think that's the real question as we're looking at some of this swing state polling that's just very deadlocked.
And Cook Political Report now has it as a toss-up race for presidential.
Yes, all of the 7 swing states we rate as toss-up, so it is as close as it can be. I mean, the polls I continue to see out, private and public, all are within just 1 or 2 points, basically.
The financial markets, though, are pricing in a red sweep. Part of that has to do with the Senate map.
Yes.
And you've done some great work on actually senators that are defending seats, Democrats, in Wisconsin, in Pennsylvania, but actually might be toss-ups. What does the map look like today?
The map is favoring Republicans, and that's why if we're looking at a Republican trifecta, that's more the most likely to flip has always been the Senate. That's because Democrats have a 51-49 majority, but we already know they're going to lose West Virginia. John Tester in Montana is the underdog, so that gets you to 51 for Republicans right then. Then the question is, as you mentioned, the races that we've seen tighten up in the past few weeks have been those blue wall states. Wisconsin, Ohio is the next probably with Sherrod Brown. That's still a very difficult state, and a state that Trump won by 8 points, but I'm seeing tightening polls in Wisconsin with Tammy Baldwin and Eric Hovde there. In Pennsylvania, that's the race that we moved last weekend to toss up with Bob Casey and David McCormick there. Michigan still remains closer. I would probably still rather be a slightly Alyssa Slotkin in that instance, but they're all very close. We've seen those races so I think as the presidential race goes, probably those Senate races go, because in 2016, every single Senate race went the same way as the presidential race. In 2020, only Susan Collins managed to win, even as Biden carried her state. So I think we're seeing a delta of just a couple of points. I think we could see split tickets in Arizona, for instance, where Trump is favored there, but the Democrat Ruben Gallego is. So.
Well, can you just walk us through what a red wave looks like, what a red sweep looks like, given the fact that not all Republicans are the same, not all Democrats are the same.
Yeah.
How much are we looking at Trump truly having a clutch over the Republican Party in a way where he could get through his policies very easily, even with just a simple majority?
think that's why you see Republicans that are wanting to get to, 53, 54 seats, because if it's just a very narrow 51-49 majority, the most important people in the Senate become the moderates. Lisa Murkowski of Alaska, Susan Collins of Maine, who's up for re-election in 2026 if she runs again. They have such a favorable map. They want to take advantage of this, especially if you see Trump winning. And I think the House is very deadlocked. You only need 4 seats one way or the other. We see that as a toss-up. And, there's some places where in here in New York and in California that are more Democratic areas that Republicans need to run ahead of. But then we have seats in Michigan that are, I think, going to be very, very close as well. So, I think that probably as the way the presidency goes, probably the House goes as well. But that's why Republicans want to sort of get that bigger majority, gives President Trump a possible cushion.
When we talk about what's going to potentially change the outcome, everyone talks about turnout and potentially who has the better ground game, who has the better early voting game. What are you seeing on that front?
Democrats have a very sophisticated operation. That is sort of their bread and butter, getting those people out, knowing where to target them. And then I do hear some concern among Republicans because the Trump campaign has largely sort of farmed this out to Turning Point USA, to Elon Musk. But then we also are seeing some encouraging early voting signs in places like Nevada, where Democrats typically have a very strong ground game there. Republicans are having much better turnout. But I think it's a question of, have Republicans sort of learned to love early voting or encourage their people? So is this sort of cannibalizing their election day voting that we typically see as more Republican? Or is this indicative of just more Republican enthusiasm than Democratic enthusiasm? We sort of won't know until that election day turnout. But Republicans banking votes early, because in Nevada, for instance, we saw that Senate race decided by just a few hundred votes, that, if they'd sort of emphasized early voting early on, they might have won that Senate seat. And that could have been they would have had a much closer, Senate this past 2
Trump
years.
gave a nod to this at the Garden, and you have seen the RNC do a lot more work to say early voting is safe. You should go out, vote early, just make sure you vote. Your best case in terms of when do you think this election will be decided?
I mean, I'm preparing. I think we can know the Senate pretty early on based on what happens in Montana and Ohio if we get those results. But I mean, I think Friday, Saturday, Pennsylvania is not going to be able to count some of their absentees. If it's a sort of a wave one way or the other, if we're seeing, North Carolina, Georgia go one way, Trump picks off one of those sort of blue wall states, we might see, I think, earlier results in a place like Wisconsin or Michigan. Or if it goes Harris, but I think if it's very close, it may not be for several days. And I think we sort of need to steel ourselves for that possibility.
This is what a lot of market participants are focused on, how long it takes to get this result.
Well, the Maricopa County election officials, I keep going back to this because it dragged on in 2020. They're saying 10 to 13 days. Now, yes, they want you going into this with a low bar that potentially they could get out of this a little bit quicker. But 10 to 13 days, I mean, we're talking about weeks, not days.
And nobody wants a repeat of that mess, that's for sure. Jessica, it's good to see you. Thanks for dropping by. Thank you. Jessica Taylor there of the Cook Political Report. Coming up next on this programme, we'll speak to Mandeep Singh of Bloomberg Intelligence. He joins us as Google prepares to report earnings after the closing bell and kick off a big week for mega cap tech results. That begins after the bell a little bit later. Equity futures on the S&P 500 right now are negative by 0.1%. In the bond market, through 430 on a 10-year, up 2 basis points. On a 2-year, up almost a basis point to 414. From New York, this is Bloomberg. Here are the scores for you this morning. Equity futures slipping just a little bit lower. We're down by a little bit more than 1/10%. Basically unchanged on the Nasdaq 100. Quite a run for the Nasdaq over the last 7 weeks. On the Russell 2000, the small caps were negative by 0.25%. The main event, it's got to be in the bond market. Switch at the board and get to the bond market story. Let's turn the page together. Here we go. 2-year, 414. Yields up for 7 consecutive sessions at the front end of the yield curve, as Lisa said a little bit earlier this morning. Soft 2-year and 5-year auction just yesterday, going into a ton of economic data this week, the first of which is a little bit later when we get JOLTS, job openings, for September. For many of you, I know the last clean read predates hurricanes. A lot of it predates some of the strikes and some of the fallout from the strikes, so maybe the last clean read on job openings in America going into election day and shortly thereafter for the Federal Reserve as well. On a 10-year, 429.83, let's call it 430. Lisa talked about some of the move we've seen over the last month or so. Yields bottomed when in September, 2 days before the Federal Reserve cut interest rates?
Yeah, September 16th. That was the cycle low, sort of in the past couple months.
2 years later, they cut interest rates 50 basis points, and we're higher by more than 60 basis points.
So here's the question that I have. Why exactly are benchmark 10-year yields 68 basis points higher than they were 2 days ahead of that September Fed meeting? Is it because the economic data has come in stronger than expected? Is it because of Trump gaining a bit of the perceived lead in the polls and in the market? Or is this just a matter of the economic data coming in better than expected and the bond market responding? We won't know the answer to this, but it raises the specter of bonds being a risk asset at a time when traditionally they have been the haven trade. And that, I think, is a really fascinating paradigm that we're dealing with right now.
So we have to describe what the risk is to work out what the risk asset might be. And the risk is you get a GOP sweep and you get all of that issuance and supply becomes a real problem. But I'm with you. The Federal Reserve came out and conveyed a real bias to reduce interest rates, regardless of how strong the output data might be. So people still believe they may well cut interest rates. In fact, the base case is they will next week by 25 basis points, even with this strong data. That just feeds this idea that the outlook becomes that much better and yields are higher at the long end. And I think that's what ultimately describes the last month or so. Do you have to sort of play in there some odds of a Trump win and GOP sweep? Yeah, I think you do to some extent. But have we fully priced some of the tax cuts from the campaign trail? I think that's a stretch at this point. I still think there's this large degree of skepticism about how much they'll actually do if they get into power.
There's a question of what a no landing looks like and a soft landing. And for those who are rolling your eyes to truly say, okay, you talk about all these terms, they mean nothing. There's a question about whether we're actually going to see the beginning of a reacceleration in economic activity versus just simply chugging along. And that ultimately is the discrepancy between yields that can stabilize and yields that are going to go higher as people recalibrate what a neutral rate really looks like.
When you look at some of the policies, if it is a Trump sweep, tariffs can happen immediately. That could be inflationary. But you look at some of these tax cuts, and every day there's basically a new tax cut. At this point, I don't know who's going to be paying taxes if we get a Republican sweep and Trump's campaign promises come to light. But that's not going to take effect to the end of 2025, early 2026. So I think immediately the bond market is going to have to price in this idea that, okay, we might get some of these, but they're not going to know which ones they're going to get. But tariffs, they could know pretty immediately.
It's pretty amazing to see where the momentum is at the moment, contrasted with where the polls are, which is still incredibly finely balanced. A coin flip for many of you, and yet here we are leaning towards this Trump trade, this idea that you can get long the US dollar, you can get short US bonds, you can get long the US versus the rest of the world. Speaking of long US versus the rest of the world, euro dollar just briefly breaking below 108 just moments ago at 107.99. 108.01 is where we are right now. And Europe is in the crosshairs, Lisa, of a lot of this.
Yeah, David Solomon over at Davos in the desert really put this well when he was saying, okay, the election, yeah. What I'm worried about is weak growth in Europe. And he listed a couple other questions that he had about the geopolitical sphere. But to me, that was the most interesting aspect. That is the honest, constant theme through all of this. Less what's going to happen to the U.S. and more what is happening on the ground in Europe.
Jeff, you was talking about parity if we get a Trump win. Why? The walls are going up, not just 10% from imports from, say, France or Germany, whether it's a Mercedes-Benz or champagne, but also the 60% imports from China. So where does China now dump even more on their market? Europe. Europe is going to struggle.
Europe, their growth engine's already sputtering. They have problems internally already anyway. You overlay this on top and they've got an even bigger issue. Euro dollar right now, 108.02. Under surveillance this morning, the Israeli Prime Minister, Benjamin Netanyahu, is saying he's open to a short truce in the war with Hamas. The latest round of peace talks centred on a plan proposed by Egypt, a 2-day ceasefire and the freeing of 4 hostages in exchange for Palestinians held in Israeli prisons.
So potentially we would see this. It would be very short. Obviously, the Biden administration would be breathing a sigh of relief, especially if they can get this done in the next week before the election. We just had Jessica Taylor talking about the fact that you're looking at that Senate race in Michigan, how hard it is because of things like Arab Americans and how individuals feel about how the Biden administration has handled this war. But there is a big but here. What has Hamas agreed to and throughout this entire process, besides 11 months ago when there was a brief pause in hostilities for hostages? Time and time again, they continuously say no. So maybe Benjamin Netanyahu says, I'm open to this, a very brief ceasefire, but is there any inclination right now that Hamas is? I don't see that.
Who is Hamas? I'm serious, like not to be flippant here, but who is going to be the leader in the Hamas camp that's negotiating? And that, I think, is one key question.
Speaking of the Biden administration, here's the latest on another issue, finalizing curbs on U.S. investment in advanced technology in China. The rules banning some investments into semiconductors, quantum computing and artificial intelligence. The goal to prevent China from gaining a military edge, the last big push from the Biden White House.
And just sort of re-emphasizing how both camps, whether it's a Democrat or Republican, have been going after potentially curtailing some of the technological connection between the U.S. and China. So a question here of how much Biden is trying to do this at a time to basically say, we're on this too. Question of the efficacy of all of these tariffs and potential guardrails is going to really haunt and loom over whatever administration comes next.
Well, this is going to come within the Congressional Review Act window. But this bipartisan support you see in Washington to be tough on China, I don't see, if there's a Republican sweep, them pushing back and saying we don't want to do that. But why did it take so long? This executive order came out August 2023. I have been talking to sources about outbound investment from U.S. investors, capital into China, that they think can have an edge in military, an edge in cyber capabilities. And here we are, the week of the election, and we get it.
Well, I think it speaks to the conversation we're having every single day at the moment. All of these grand plans on a campaign trail, it doesn't matter. It takes a long, long time to get things done in Washington, D.C., and often you have to focus one thing at a time and then get to the next thing further down the road, which can take months and sometimes years.
Are you advising markets to be patient?
No, I'm just saying that it could be that you have to wait a long, long time, even if you get a GOP sweep, to get the tax cuts maybe you will want.
Yeah, well, I mean, this is sort of the key question. You know, if you're a forward-looking mechanism and you're being told forward is a very long time forward, people are saying, I want to know now. And that's basically what's going on in markets.
Equity futures down about 0.1%. Later this week, you can wait for this, earnings from Apple coming up on Thursday. Sources telling Bloomberg Apple's iPhone exports from India jumped by a third in a 6 month through September. The numbers underscoring the company's efforts to expand manufacturing in India and reduce dependence on China. And China's going to be a huge feature of earnings season this week for the tech players.
This, to me, is a fascinating story at a time where Tim Cook is top diplomat to China from the United States, talking about how he's committed to China, doing tours of people who are buying iPhones in the mainland, and yet still stealthily moving production to India with a question of, A, is that going to be the next growth engine? But B, how do we sort of diversify away from China should there be another problem? And that is what we're seeing. Look what they do, not necessarily what they say.
Apple, one of 5 Mag 7 companies reporting earnings through the week. Google, coming up after the closing bout today. The company expected to post strong revenue and profit growth driven by the cloud computing division and internet search business. Mandeep Singh of Bloomberg Intelligence is with us around the table. Mandeep, good morning.
Morning.
Alphabet at the start of this year, existential crisis, not in the AI game. They're going to be disrupted. And here we are up 20%. What went right?
Well, clearly they have released, their own large language model and they have seen some traction. But I would say the expectations are still low. Everyone expects, ChatGPT to take away some of the search share from Google. And just overall, I would say in terms of sentiment, the sentiment is still somewhat neutral on Google compared to a Microsoft or, Apple for that matter. And that's where I think they can surprise to the upside simply because, what they have done is not only on the search front, they've released a model, even on the chip front, when it comes to training these large language models, the next version, some say will cost $1 billion. Well, Google has their in-house chip to train these models, and I think that's where the advantage will become very obvious.
There has always been this regulatory burden on the horizon that is haunting these big tech firms. It feels like that burden is getting bigger and bigger. There's almost like this massive grey cloud now that they have to confront over the next 12 months. How very real is that threat?
I mean, it is, in terms of, the number of cases that are pending in the U.S., let alone, outside. And that's where they have to kind of restrain themselves from being very aggressive when it comes to tapping these markets. I mean, look, YouTube could easily expand into some other domains, but given how dominant it is, I think that's where the effect of regulation comes into play.
I just got to jump in. Are you saying this company is not going as aggressive as it could do? It's limiting its own growth because they're worried about what might happen in Washington?
Absolutely. I think it affects the perception. I mean, for a while, everyone thought, and for a good reason, Google was the monopoly in search. Now, at least everyone believes there is a lot more competition coming from all these other players that are building search around large language models. So they are definitely not the first ones out there in terms of, adding another product or feature because they are so dominant in the businesses they operate.
So which areas are you looking for signs that they're basically revving up their ability to expand should the environment be conducive to that? How much is it important for them to make a greater inroad into cloud computing, to be a real competitor with the likes of AWS and Azure?
Yeah, so that's where I think they have a lot more runway in terms of both, expanding as well as making acquisitions. But look, when it comes to cloud, even that is a segment with a long runway, simply because they have all the capabilities in-house. Even a Microsoft that is growing their 80 billion Azure revenue at a 30% growth rate, they're dependent on OpenAI. In the case of Alphabet, they've got all the ingredients in-house, their own model, their own cloud infrastructure, they can deploy it. And that's a big, powerful advantage because all these models in the end rely on proprietary data. You have to have technology to, train these models, and Google can do it all in-house. So that's where I feel the moat will become more obvious as we go along in terms of scaling these models. But right now, obviously, I think the regulatory pressure is limiting them in terms of how frequently they release new products.
Is there a particular company that they would want to buy if they could regulatorily?
So a security company, Wiz, was in the news. They were looking to acquire that, but Wiz turned down that offer, and it was a significant $23 billion offer that they were willing to make. So that's where they are looking to expand on the enterprise side because they're so dominant on the consumer side. And that's where I think from a regulatory perspective, they have fewer hurdles to overcome because at least they are not so dominant on the enterprise side.
So if they're so worried about policy out of Washington and regulatory concerns, is that why Sundar Pichai is calling up the former president and telling him his McDonald's stunt was a great hit on Google to have this check-in?
I mean, look, I think for all these big tech CEOs, what happens on November 5th does have a bearing on who is at the regulatory bodies and how these cases progress. And look, if there is one thing that is a big risk for Google is even a forced divestiture of one of their segments will have an impact. I mean, remember, Google's infrastructure is shared across all their businesses. Even Waymo could be a big business down the line. And it's all powered by one common infrastructure. So forced divestiture will have an impact.
But Mandeep, this is a change from leadership in Silicon Valley. They used to cloak themselves in this liberal view of the world that we're here for the greater good because they were worried about the threat from the left. Now they have to worry about the threat coming from the right as well. If you listen to Senator J.D. Vance and some of the things he says about big tech, these are capitalist individuals but are worried about the dominance of a select group of companies in America. And they're willing to do something about it based on the communication I've heard over the last 12 months. How are these tech firms shifting the balance down in Washington, D.C., the lobbying effort, their approach to these conversations, when all they used to have to worry about was the left, and now they need to worry about the right as well?
Yeah, look, I think they just have to show why, they need to be big in terms of developing this AI infrastructure. I mean, look, everyone out there is trying to develop artificial general intelligence. That's the end goal. And the way you do it is by investing in big infrastructure. That's the only way you can get to AGI. So they have to show it to the regulators and to everyone involved why, the scale is so important when it comes to developing this new technology.
Mandeep, it's good to see you. Massive week. No doubt we'll catch up again later this week. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Alphabet earnings coming up after the closing bell. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs CEO David Solomon is optimistic about the U.S. economy, saying his base case is for a soft landing. Solomon joined Bloomberg in Riyadh.
If you took a tour around the world, the U.S. economy is actually doing quite well. It's been very, very resilient. I'm a little bit more concerned about European growth and also the economic situation in China.
Solomon also said that Fed rate moves will be data dependent next year. Pfizer shares, those are jumping in the pre-market trade nearly 2%. They reported a third quarter estimate that topped estimates, rather. It also boosted its outlook for the full year, saying it was on track to deliver $5.5 billion in cost cuts. Pfizer will have been aiming to quiet critics with this report, coming under pressure from activist fund Starboard to find new hits in a post-COVID vaccine era. And it was the American sports fan favorite day of the year. Monday saw all 4 major U.S. sports in action, likely for the only day this year. The phenomenon is known as the sports equinox, and it's only happened 30 other times in history. A full slate of NBA and NHL games were happening at the same time as the Game 3 of the World Series and Monday Night Football. In the NFL, the Steelers took down the Giants to win their 22nd straight Monday night home game in a streak going all the way back to 1992. And that's your brief, John.
Tough 24 hours for New York sports, unless, of course, you're a Mets fan. Is
Well,
that right,
hold
Lisa?
on. No, hold on a second.
No, okay. All right, just correction
I
incoming.
am actually rooting for good games, close games, close series.
Are you
It's unfortunate
disappointed
when it's a
for
blowout.
different reasons?
Yeah, I think that
Okay.
it should be competitive.
Good
It's nice
hedge.
to see people actually work hard.
Good hedge. Did you hedge this? Crocs down hard in the pre-market and early trading, down by more than 10%. Investors not enthusiastic about the outlook from this company this morning.
Seeing revenue at the lower end about up 3% versus the estimate of seeing somewhere between 3 and 5%. A real question, revenue for Hey Dude down about 14.5%. That was on the bigger end. You're laughing. I mean, maybe it's the, high heel Crocs that
no
people are
idea.
looking at right now, and maybe they're not cool with the kids anymore, and the little sticky things that they put in the holes. I don't know. I know that Anne-Marie was a big Crocs fan, but now I heard that she's kind of moving away from
I'm
them.
definitely not a big Crocs fan, but my nephews are.
Okay.
Kids love them, like little kids. They call them slip-on shoes, and they think it's so fun.
Because they don't have to learn to do the shoelaces.
Because they're slip-on.
Yeah, precisely.
Sorry, this is sort of the truth. I mean,
Not
they're
my thing.
practical.
I can't
No,
help.
and the little Pokemon.
Exactly,
all
the
the
little
fun.
stamps. Look, but I think that they're losing their appeal. I think
The
that there are other
charms.
things. I'm just saying.
Stock is down by 10%. Enough said. Up next on the program, sounding the alarm on policy risk.
Trump policies will lead to more inflation, larger deficits, lower economic growth, and enormous amount of disruption in the short run.
That conversation up next. The former World Bank president, David Malpass, just after this commercial break. Equity futures on the S&P just a touch softer. We're down by 0.1%. Under surveillance this morning, sounding the alarm on policy risk.
There is no comparison between the economic policies of Trump and those of Harris. Trump policies will lead to more inflation, larger deficits, lower economic growth, and enormous amount of disruption in the short run. He has such control of his party. If there were a Republican Congress, those cuts might be put into place.
So here's the latest. Economists debating the impacts of Trump and Harris policies on the U.S. economy. Both Harris and Trump projected to add trillions to the U.S. deficit, with many experts cautioning against the effects of Trump's vast tariff proposals. Joining us around the table, the World Bank president, David Malpass, the former World Bank president, David Malpass. Good to see you, sir.
Hi, John. Good.
Fantastic to catch up, as always. David, as you know, there is a massive difference between a campaign promise and legislative reality. How big is the gap between the two right now, given the campaigning that you've seen?
It's huge. So the campaigns are both promising the air in the sea, but as Washington gets at things, this is how Washington got to be huge. They chew up policies. And so one of the things is to be very clear about what policies are the most important. One from Trump is that we need to produce more energy and fix the grid so that there can be more growth within the economy. So just full stop. Can you do that? Well, that's really hard to do. Same on the taxes. The tax code is really fouled up. It doesn't do what people are trying to get it to do. Can it be changed? Well, that's really hard. And so people need to recognize, I call it an upheaval, the need for upheaval in budget policy, in monetary policy, in regulatory policy. That's hard to do.
What kind of upheaval? Because, well, first off, you talk about energy. Right now, the Biden administration is producing more energy than under any administration ever. But what kind of upheaval? Elon Musk the other day talked about $2 trillion can be shaved off. Where?
When you say energy growth, you have to go against what baseline? So could the U.S. be producing a lot more energy? And the answer is very clearly yes. One of the problems is in the Permian Basin, which is this remarkable field in Texas that they keep saying is exhausted, but it keeps producing world record amounts, doesn't have the pipelines to get the energy from the fields into the cities and around the world where it's needed. You know, Texas is producing this giant amount of energy for the rest of the world because they're behind as well. On the $2 trillion, every part of the government can be done more efficiently. Plus, look at what Harris is talking about, a giant growth in government. The CBO forecasts right now have us going from $6.3 trillion this year all the way to I think it's 10.3 trillion. So it's the most massive growth planned for the U.S. government that anyone's seen.
But
can
David,
that be cut back? Yes.
But David, unless the Trump campaign and potential administration is willing to cut in Social Security and Medicare, where are we saving them? Even if Trump fired, which I know he loves that word, every single federal employee, you only save some $300 billion. Where is this $2 trillion coming from?
But think what I said, we're going from 6 trillion to 10 trillion plus on both sides. If you went to 8, you would have cut 2 in quote cut, which means slower growth. You can do it that way. But I think there's direct ways. People across the country know of government programs that shouldn't be there. Federal government is subsidizing everything. And so that can be cut without it really harming. Think what happens if you don't employ the person as a government worker, a federal government worker. They are allowed then to work in the private sector, or they will end up working in the private sector. They'll be more productive. They'll actually get stuff done. So the government is crowding out private sector business all the time.
Just quickly here, how much are we seeing this getting priced into the Treasury market? How much is this what you see as behind some of the increase in longer-term yields?
We were at 0% rates for a long time. That I think it just is taking markets a long time to figure out what is a neutral rate. And that does depend on what your policies are going to be. So if you're going to have a weak dollar policy, as it seems as if Biden-Harris have had, then that means you're going to have higher interest rates. If you have the dollar as a reserve currency, the yield curve can be lower, and you can do it from both the short end and keep the increases away from the long end. So I think markets are really responding to where they think the policies are going to be. Now the positive side is if you say something sensible today, the markets will price it in today. They won't wait for that out into the future.
If you say something sensible today, you probably won't win next week, and that's kind of the problem. David, it's good to see you. Thank you, sir. David Malpass, the former World Bank president, on the difference between a campaign promise and the reality of getting things done down in Washington, D.C. Up next on this programme, we'll catch up with Tom Becker of BlackRock, John Murthy of Bank of America, Lydia Boussour of EY, and Mona Mahajan of Edward Jones. As we count you down to the opening bell, about 94 minutes away, equity futures on the S&P 500 slightly softer. We're down 0.1%. The third hour of Bloomberg Surveillance up next.
Street is even more bullish on Trump winning than the predictive markets are.
The most bullish for the dollar is a red wave.
Yields, I think, are moving higher based on the election.
To have a closely contested election would be very unsettling to the bond market.
I think inflation is due to notch higher, or at least stay stubbornly stuck where it is, no matter who wins.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, the third hour of Bloomberg Surveillance starts right now. Let's start with equities and then we'll move to bonds. Equity futures, your scores look like this on the S&P 500. Just a little bit softer so far this morning. Likewise on the Nasdaq, down a bit more on the Russell. The small caps negative by 1/3. Some new levels to talk about in the bond market. A 10-year through 430. Yields higher by 2 basis points and yields up again on a 2-year for a 7th consecutive session. We'll go through the day ahead, and then we'll get to the big three for the week ahead. The day ahead looks like this. We get some data later this morning. JOLTS job openings, 10 a.m. Eastern time. Don't miss that. Then after the bell, the first of 5 Max 7 earnings reports this week. We'll hear from Alphabet after the close. Then the week ahead, the big three. Payrolls on Friday. And then next week on Tuesday, we're going to get an election result, I hope, Wednesday morning, potentially. Could be election week. And then after that, 2 days later after that, we're going to get a Federal Reserve meeting. Good luck to the FOMC.
Is this fun? Are you having fun yet? I love what Jason Draho said over at UBS. Exhilaration is not the first word that comes to mind when thinking about the election. Maybe anticipation for some sort of certainty. It's about the election. It's about the Fed, especially at a time where you have those yields creeping higher. And that's why I think that is the main theme. Why have you seen this 68-point rise, basis point rise, in 10-year yields at a time where the Fed is still on track to cut rates? And that mystery, I think, is underpinning a lot of this uncertainty that we see in markets.
Depends who you ask, whether or not it's economics or this Trump trade that's being priced in. Jessica Taylor, sorry, Jonathan, Cook Political Report, talking about it may take days, at least for the presidential race, if it's that tight. That means maybe Friday, maybe Saturday, like 2020. So we can have a Fed sitting down 48 hours after a presidential election, not having an answer of what policy is going to look like going forward.
We've said it repeatedly on this program for months. We're flying blind into 2025, and it's hard to have conviction about absolutely anything. This just came in from a Bloomberg subscriber. The market seems to be clear on one thing and one thing only. The 50 basis point cut last month was the wrong move. And that individual's got some company.
You know, there is an increasing number of people saying that maybe the Fed will cut 2 more times this year, but after that could be on hold for quite a while because there is this better than expected data that's been coming up. You see the better than expected economic surprise index by Citigroup and Bloomberg. A question here, though. What is what we're seeing right now in the bond market? Is it a Trump trade? Is it that it was a mistake? Are we seeing inflation expectations absolutely skyrocket? Not really. If you look at the break-even rates, they are creeping higher, but there is something else afoot, and we're seeing it in auctions, and we're seeing it with the deficit, and I think that that is something we got to keep focusing on.
Soft auctions, I'm told, in the last 24 hours on 2s and on 5s as well. We get more this week.
$44 billion today, 7-year notes.
Look out for that a little bit later on this afternoon. Your 10-year at the moment this morning, 430, up 2 basis points on a session so far. Stacked hour coming up, so let's get to it. Tom Becker of BlackRock with stocks rising a week out from Election Day. We'll speak to John Murphy of Bank of America Securities on Ford's disappointing forecast and Mona Mahajan of Edward Jones on why the bull market is still intact. We begin this hour with bond yields climbing ahead of a week full of jobs data. With just 1 week to go until Election Day, BlackRock's Tom Becker saying we are positioned for a continuation of transatlantic growth and deficit divergences that should widen interest rate differentials between the US and Europe. Tom joins us now for more. Tom, good morning.
Morning, John.
Let's get to the why. What's the why behind that call?
Couple different aspects to it. I think last time we were on, we talked about kind of the no landing scenario in the U.S., and I think the conversation you're just having about the 50 basis point cut, subsequent revisions, data looking stronger, I think that's an aspect of it. But fiscal is another big aspect of this. So auctions haven't been digested that well. You've got the QRA yesterday, which came out kind of toward the end of the day. So this quarter, not so big, but the forecast for Q1, kind of the biggest Q1 on record, $800 and change billion. So we've had this kind of upward trajectory in kind of the amount of debt that the U.S. Bond auctions have to digest. And so what we see is that kind of puts upward pressure on yield. That money is actually crowding. Our view is that money is crowding in investment. So when you look at kind of where some of this deficit spending is going, it's going into structures, it's going into CHIPS Act recipients, it's going into Inflation Reduction Act recipients. That's bringing private capital into parts of the economy, helping to make it less interest rate sensitive, but also keeping nominal growth pretty high. And so I think we've seen this kind of upward revision in activity. We think kind of the deficits are helping to kind of keep the U.S. Looking stronger in the global cross-section.
This is a transatlantic call.
Yeah.
Give me the contrast, the difference between what's happening over in Europe.
Couldn't be more different, right? So here you've got companies kind of lining up to take the subsidies. In Germany, they're kind of saying, no, thanks, we don't want to build our chip plant here. We don't need the subsidies. the news over the weekend kind of the layoffs in Volkswagen. So you're seeing a very different labor market. You're seeing consumers in Europe respond differently to that. Savings rates are up because precautionary savings. People don't feel as secure in their jobs. The investment is not flowing through and kind of keeping growth quite as high. And you've got things in the German constitution like the debt brake. Tomorrow, big day for the UK. We've got Ms. Reeves coming out with her budget. The last couple months, gilt markets have definitely been concerned about a repeat of the 2022 mini budget event. So that's been putting upward pressure on global yields. But we think that's pretty transitory here. We think kind of the growth, the inflation in Europe, we think the likelihood of them, making the same mistake twice actually unlocks some value in UK yields, and then German yields we think should just come down on the weaker growth, the weaker inflation.
We're already looking at about 2 percentage points of a gap between German 10-year yields and U.S. 10-year yields, and you're talking about an even greater widening out.
Yeah.
At the same time where the ECB has to explain why they're not cutting rates more aggressively, and the Federal Reserve has to explain why they're going to keep cutting rates. Right. And this is sort of the divergence that you're talking about. So from BlackRock's perspective, from your portfolio, is this a long dollar and long U.S. bonds or short U.S. bonds? Is it long dollar and long European debt? Because that's going to benefit from this whole trade. Yeah,
Lisa. So in the portfolios, we run their macro portfolio. So we're trying to time asset classes and countries. We think this fiscal dominance is going to pervade asset classes. So we think about the themes that are going to kind of be impactful for FX markets and bond markets and equity markets. And we think we're in a fiscally dominant environment here. We think that's actually going to put downward pressure on the dollar. So we've got a big election next week. Tariffs are definitely going to shift the kind of winds on that. But we think kind of quarter after quarter, kind of the amount of issuance that's coming into the markets, the U.S. needs foreign bond buyers to step in and be the marginal buyer. And so we think over time, the amount of issuance coming in the U.S. should weaken the dollar. So position for a weaker dollar on the issuance, but then a widening of kind of long-term yields because of the amount of duration that Janet Yellen's putting into the market with kind of quarter after quarter of higher bond issuance.
Is this basically the U.S. losing its mantle of exceptionalism, or is this the idea that the dollar can weaken, but still the U.S. economy can grow at such a pace that it still is a place of equity outperformance?
So I think the latter is kind of how we would position. So prices will adjust, supply of bonds and kind of better growth and a Fed that maybe doesn't cut as much as the ECB. We think that can keep the divergence on yields moving wider. But we think, with the backdrop that we have stateside, the growth can kind of continue with kind of strong consumers, strong reindustrialization policy. We think the tailwinds are kind of structural, but the prices still need to adjust wider. So we need kind of higher yields to tamp down on activity. So the yield curve only just uninverted recently. That's a very strange situation to have kind of for as long as we've had it. Those low yields at the long end encourage investment. They make the return, there are more NPV positive investments out there when you've got 10, 20, 30-year financing at that low rate. So we think this kind of the higher yields should put a natural damper on activity, which would benefit kind of the Fed and kind of the whole U.S. backdrop.
Tom, you mentioned the Treasury Secretary and her debt issuance. Don't you see that level of debt issuance continuing regardless of who gets in the White House?
So a lot of it's structural. So entitlements are indexed. You've got CHIPS and IRA, which have multi-year kind of progression into the markets. So yeah, I think kind of we're in a structurally higher deficit environment. And I think that's juxtaposed against Europe, which is talking about tax hikes, talking about ways to balance the budget. I mean, the conversations just couldn't be more different when you kind of look at what Reeves is dealing with some of these nuances around, PS, NFL. Like, they're talking about the nitty gritty of the deficit. In the U.S., it's kind of like, is it big or is it really big? So the kind of conversation about, can we raise revenue? Do we have a kind of a home base on how big the deficit should be? 6+% deficits with this amount of economic activity is kind of unprecedented for the U.S.
How much harder is European leaders' jobs going to be if it is the former president and he puts up the tariff walls?
I think the responses to tariffs would be a big one. But I think markets have had time to adapt. Leaders have had time to kind of think through what is our policy in this new environment. And so, we're gonna take that when we're gonna cross that bridge when we get to it. But from here, we think kind of the backdrop is one where leaders are really looking to kind of keep growth going in the U.S., but in Europe, kind of keep bond markets kind of satisfied.
My bet would be that if we get those tariffs, your trade on long European bonds duration works even better, doesn't it?
To the extent that they're much more of an export-driven economy, I think it could hit them. So if you think about the German economy, they've kind of levered themselves to exports, kind of a neo-mercantilist type of setup for the last 2 decades. And global trade hasn't been growing as quickly.
Yeah.
You've got kind of companies and countries looking to do more closer to home. And so that's a tough backdrop for countries like Germany, like China, that kind of want to grow through exports. Whereas in the U.S. now, we're kind of growing with domestic demand and domestic production.
Speaks to the divergence that you'd be expecting. You said something that I want to pick up on and kind of finish there. You said that high yields might help the Federal Reserve. Is that an odd thing to say, to think about when they just cut 50 basis points last month?
So I think the Fed controls the front end of the yield curve through policy rates.
Yep.
But they still have skin in the game with their balance sheet. And earlier this year, Waller spoke about kind of the composition of the balance sheet for the first time, something we were thinking about. We called it QT Light. This kind of QT2 that they've done, they haven't sold quite as much duration back into the market as they did during QT1. And part of that means they're kind of holding on to more of these long-dated, 10-year equivalent bonds on their portfolio. Lori Logan spoke a couple weeks ago, very important speech. She's kind of on point for kind of the balance sheet. Usually she talks about liabilities. She mentioned, our asset side looks a little long compared to kind of, where the issuance is. We're going to have a conversation about this. And so I think kind of there's a potential that the bond market is also looking forward to maybe some of the compositional changes that might impact kind of long-dated yields versus policy rates.
Is there a conflict in that? Aren't we meant to be unlocking the housing market? Is there a conflict there between the goals of managing the front end and doing something about the long end?
I think the inflation target and the unemployment rate are Jay's pretty clear about that. He got asked at the last press conference, what do you think mortgage rates are going to do? He said, he didn't really have a great answer on it. But there's Treasury rates and then there's spreads, and so you could see a situation potentially where if the yield curve gets more upward sloping, it gets more attractive to issue mortgages. So the spread versus the kind of risk-free rate is something to think about. But you've got a lot of kind of short inventory, a lot of demand in housing. There are other factors besides just the yield. And so I think it's important to just think through the totality of kind of the economic backdrop and not, fixate on individual sectors or individual parts of the economy. It's so big and diversified.
This was really thoughtful. It's good to see you, as always, sir. Appreciate it. Tom Becker there of BlackRock, looking for increased divergence, transatlantic divergence on deficits and on growth as well. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu says he's open to a short truce in the war with Hamas. Egypt proposed a 2-day ceasefire and the freeing of 4 hostages in exchange for Palestinians held in Israeli prisons. Netanyahu said he hadn't formally received a proposal, but said he's willing to agree to such a deal if offered. Apple's iPhone exports from India jumped by 1/3 in the 6 months through September. People familiar tell us that the U.S. tech giants exported nearly $6 billion of India-made iPhones. That puts annual exports on track to surpass the about $10 billion of fiscal 2024. India is a crucial part of Apple's efforts to lessen its reliance on China, where risks have been growing alongside Beijing's tensions with the U.S. JetBlue shares, those are plunging 7.5% in the pre-market trade. Its loss for the third quarter was better than feared, but its forecast for the current quarter and the full year fell short. Cuts to flight capacity have failed to notably boost fares. The outlook also suggests that JetBlue's efforts to reduce expenses and boost revenue have been progressing slowly. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, The Morning Calls Plus, we'll catch up with John Murphy of Bank of America as Ford lowers its full-year earnings forecast. That stock having a difficult morning. That conversation up next. Equity futures on the S&P 500 just a little bit softer. We're down by 0.1%. Bond yields a bit higher, up 2 basis points. The 10-year 4.30.43. Let's get you some morning calls. First up, TD Cowen downgrading Tapestry to hold, citing recent stock gains and worsening trends in China. Your second call from Jenny Montgomery Scott upgrading First Solar to buy from neutral. The analyst saying a Trump win and tariffs would be a positive for long-term pricing. That stock is up by 0.5%. And finally, next up, Barclays raising its price target on Tesla to 235 and maintaining an equal weight rating, citing improving fundamentals. That stock just about unchanged after a mega run-up through last week. Sticking with autos, Ford lowering its full-year earnings forecast after reporting underwhelming 3Q results. Bank of America's John Murphy reiterating its buy rating, saying with a strong near-term product cadence combined with management's focus, we expect better profits and progress in 2025. John joins us now for more. John, welcome to the programme, sir. Can we just start with the compare and contrast between what we heard from GM, what we heard from Tesla, and what we heard from Ford after the close yesterday?
Sure. Thanks for having me. So I think the real delta here, particularly versus GM, which is a more direct comp, is execution of Ford is okay, not necessarily great. We're still dealing with sort of the boogeyman of warranty issues, which they can't necessarily clear the decks on completely. And on the EV front, GM is probably about 2 years in front of Ford. So the improvement that we expect in EV losses at GM will probably be executed between 24 and 25 at GM, will probably be executed over the next 2 to 3 years at Ford. So those are the major differences. Sort of mid to long term, on the autonomous future, obviously, Tesla's making a lot of noise about this, and we think GM will on Cruise in the coming months and quarters. So on the AV side, there still is a void at Ford that needs to be filled. So there's a number of deltas here, but the truck platform, or the truck franchise, I should say, is still very strong at Ford.
John, can we just talk about the difficulties in the EV business? GM, of course, was a little bit more reluctant to lean into hybrids. Ford was less so. Where's that lean now? What does that look like? Where are they placing the emphasis of the company on where they want to be several years out?
So I think we have a much heavier lean into EVs at GM, obviously, with the Ultium platform. Ford is working on a Skunkworks platform, which is being worked on out of California by mostly non-auto folks, more in the tech world, which will address probably the small and mid crossover segments, as well as the small car segment to some degree. And I think Ford will continue to use a multi-propulsion strategy for trucks and large crossovers. So that puts them probably in the near term in a pretty good position in blue, which is quote unquote the ICE and hybrid business, but a little bit behind certainly on Model E, which is the EV side of the business.
John, will these results and the reaction that we've seen in the shares so far year to date, really underperforming, going to push for more cuts at Ford?
Well, I think in the near term, all companies are very focused on cost cutting, and they have to do that to drive their core earnings and cash flow, not just for satisfying stock and investors in the short run, but also funding the future. I think as you look at this, there's a very significant difference in cap allocation between GM and Ford. And GM is very aggressively buying back stock right now. So in addition to reasonably better execution, you have a strategy that investors like more in the short term because the share count is shrinking in a flat, obviously, an earnings environment that can drive EPS growth, which is what investors really should focus on. At Ford, they're focusing on 40 to 50% of free cash flow being distributed to shareholders via the regular dividend and a supplemental dividend. Some folks don't necessarily love that. Some people do love that. It's a very different strategy as far as cap allocation. And Ford has also mentioned the idea that they may let cash build up a little bit on the balance sheet and not even fully distribute that 40 to 50% in the guise or sort of in response to a tough macro, an uncertain macro, as well as potentially organic investment opportunities, I think mostly around the pro and the service business, which has good profits and much higher returns than the rest of the business.
Ford might be underperforming GM, at least this year. But, John, it still is looking fantastic compared to some of the European manufacturers. And I love your idea about just what is the distinguishing feature between the GMs and the Fords of the world versus the Stellantises and the VWs, why there is this growing divergence between the U.S. and Europe. Is it the fact that the cost of labor is cheaper? Is it because Chinese cars are not really coming into U.S. shores?
I think on your earlier segment, there was a very interesting comment made about how Germany specifically had got intertwined with China, not just in the auto business, but in the industrial industrial exports, whether machinery, tooling, and the like, even beyond autos. So I think there is a much higher safety level here in the U.S. market for the key franchise of GM and Ford around trucks than there is on the G3 or VW on their core European business, as well as the massive profits they've generated in China, which are now under pressure. So the D3, particularly I should say GM and Ford, really have not been as reliant on China as the rest of the industry, and they are more protected here at home. On Stellantis, they just got off sides on inventory and mix in their current dealer inventory, and that's been an issue that is been growing for the better part of the last 2 years. It helped them generate a lot of profits over the last few years, but now is a real weight right now.
John, you mentioned the warranty costs at the top of this segment. Why are they so high? Because the CEO said they're really not coming down as they would like them to be.
So there is warranty and sort of catch up on field service actions and other quality issues that are being executed beyond warranty, and they're really to make things right for the customer. So there has been quality issues in the past that are kind of sneaking up and popping up right now, as on sort of in the field, if you will. The current generation of vehicles is apparently much better quality than what's been going on for the last sort of 5 to 10 years, where these issues are arising. But it's very difficult for a management team to go deep into what is millions of units of vehicles on the road and really understand whether it is truly all clear. So I think that's sort of the sense of caution the management team has here, is to not sound the alarm that things are all clear right now, and you can really not worry about this past warranty or quality issues. But it is a major question. It is something that's coming up in the rest of the industry. Hyundai's got a big stop sale on Santa Fe's around powertrain. The Germans have a number of issues with brakes. GM's had some warranty issues that have popped up as well. And I think there's an overfocus, well, not an overfocus, but there's an increased focus on different kinds of powertrain and a whole lot more around AV. And a complex business has gotten just that much more complex. So the eye has been taken off the ball on some of these core quality issues. And I think it's a broader industry issue that seems to be more extreme at Ford, and probably is a little bit, but it's something we're going to be dealing with for a while. Good for dealers on the warranty side.
Well said, John. Appreciate it. John Murphy there of Bank of America. John, appreciate it. What has to be the toughest industry on planet Earth right now, right? I can't think of many others.
Especially given the uncertainty that we're talking about with policy, with the geopolitical trade relationships. And then, of course, there's the fact that consumers are a little bit fickle occasionally.
Bramo's decided to exit early, so you're not going to see Lisa for the next 30 minutes. She's going on assignment. Is that right?
I'm going to go check out the car dealerships to see what the dynamic is going to be.
Lisa, thank you. Coming up next on the programme, Lydia Boussour of EY, Mona Mahajan of Edward Jones. As we look ahead to jobs data, we'll catch up with Michael McKee a little bit later. $60 minutes away from the opening bell. Equity futures right now on the S&P slightly softer. We're down by a little more than 0.1%. On the Nasdaq, unchanged. Big afternoon coming up for the Nasdaq. Big week coming up for the Nasdaq 100 through this week. With 60 minutes until the cash open with your morning movers, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, very good morning. Yeah, those hyperscalers better not disappoint. Pfizer has essentially been living in the twilight zone. Life after COVID. Well, actually, COVID and their drug for COVID came into play. $2.7 billion for vaccines in this quarter. $442 million of an order from the strategic stockpile of the United States of America. So we're trying to grapple with, well, what is life for Pfizer after a major COVID vaccine rollout? It was about deals. It was about a $70 billion string of deals that they're doing. So they're going head-to-head with their activist investor, Starboard, at the moment to justify the $70 billion of deals and what they're doing with the R&D. They've raised the guidance $61 to $64 billion. And in that instance, we're up 1.14%. Up 4% for the year. Serial underperformer relative to the market. McDonald's, the Happy Meals, that is what you enjoyed in the third quarter, and you kept coming back for them. But international profits are down. Slippage on the net profit by about 3%. International sales, down by over 2%. So this does not include the E. coli incidences that we have at the moment. 75 people so far suffering from this, and a 7% drop in overall attendance at McDonald's. I can tell you this, the footfall is down nearly 10% in the past 7 days, 33% drop in Colorado, and in Wyoming down by 29%. You spent a lot of time on Ford, so I won't dwell, but I will put this to you. What does Jim Farley need to learn from Mary Barra in terms of executing on EVs? They are bleeding still on EVs. You spent time on this. They're going to lose $5 billion on EVs. It's going to be a 2-year transition until they make money. What else does Jim Farley need to do that Mary Barra has done, even as the combustion engine for them, Jonathan, slips on last year's numbers as well? Tough times at Ford.
Really tough times. Manus Kranich, thank you. A few stocks to watch going into the opening bout. Ford is down to the pre-market by more than 6%, close to 7% lower. Want to check out the bond market as well. Some new numbers for you on a 2-year and on a 10-year. The 2-year is up for a 7th consecutive session. We're up by 2 basis points to 4.16. On a 10-year, up by 3. Through 4.30, 4.31.64. The morning the Federal Reserve cut interest rates by 50 basis points, that 10-year opened at 3.64. We've had a move of more than 60 basis points. Mohamed El-Erian this morning on Bloomberg Opinion. The bond market has responded oddly to the Federal Reserve move. This is what he has to say, and I think this is a key line for us all to think about going into the next week. While most analysts agree on the list of potential contributors to this unusual development, there is little consensus on their relative importance. Which one is more important? The economic data, the deficit issues, the election, all of that still to come. We're going to work all of that out in the next week or so. Investors all need to work out this as well. The data this week with October payrolls dropping on Friday. Lydia Boussour of EY saying the October jobs report will be muddied. 2 hurricanes and labour strikes will render the data much noisier than usual. We expect a non-farm payroll gain of only 70,000. Lydia joins us now for more. Lydia, welcome to the programme. When you look at that data when it drops on Friday, is one survey more reliable than the other, household versus establishment?
Good morning. So we're likely to see some hurricane impact, mostly in the establishment survey. We're looking for a drag on payrolls from both the hurricanes and strike. We already know from the BLS strike report that there is going to be 40,000 workers that are going to be falling off the payroll in October because they were on strike. And then if you layer on top of that the impact from the hurricanes, we're likely looking at a drag of over 100K on payrolls. Then you look at the household survey. The strikers are going to be counted as employed in the household survey, but we're going to be closely watching a few key indicators. You have to look at the number of workers that are not counted, that are not at work due to the weather, but are still counted as employed, and also temporary layoffs, which could show also some impact from those disruptions.
Lydia, how will you draw a distinction between what is temporary noise and what is cyclical weakness?
Yeah, it's going to be quite challenging to look at that. But, if you try to look beyond that noise, we've had job growth over the past 3 months, averaging 186,000. We think that the trend in job creation right now is likely around 175K. And we think that if you extract from that noise, you're likely to be, around that kind of trend pace in job growth. But the October jobs report and the November jobs report will carry that noise. So I think you'll have to rely also on other economic data. We're going to get the JOLTS data this morning, unemployment claims, and all the other labor market indicators that are pointing to a gentle slowdown in the labor market.
So does all the other data trump actually this non-farm payrolls report?
They're going to be complementing the data we're getting in the jobs report. We're going to be looking at the JOLTS data this morning and trying to gauge whether we continue to see that slowdown in labor demand, whether labor market churn also it has decreased significantly. So we'll be looking at the quits rates, the hiring rates, which have declined below their pre-pandemic pace. So I think all the data is important. We know that Fed officials are also closely watching anecdotal evidence. The data and the evidence from the Beige Book are also quite interesting when you look at what we're hearing in terms of hiring, in terms of pricing power. So both the economic data and the anecdotal evidence are going to be important. Now, in terms of the Fed and how they're going to be looking at that jobs report, I think they're going to be looking through that noise, and we're expecting to see a 25 basis point rate cut in November based on the economic backdrop. Inflation continues to move in the right direction. And as I said, the labor market continues on that gentle slowdown.
You think we're going to get 70,000 jobs added to the market. What kind of number do you think would put the Fed on pause, even though you're expecting a 25 basis point cut?
Well, that's not our base case. I think, if you take a step back from every single data point and you look at the underlying fundamentals, I think there's still room for the Fed, to implement a few rate cuts from here. We have a labor market that has rebalanced, that's no longer putting upward pressure on the wages. We have also inflation that's moving in the right direction. We'll get the inflation data this week, but there is more disinflation in the pipeline. We're expecting a moderation in economic activity as we head into 2025. We know that pricing power has come down. We're also hearing that in our conversation with clients. We also have more housing disinflation coming in. So if you look at that balance of risk with the inflation picture and the employment picture, I do think that the Fed will remain on track for easing and 25 basis point rate cuts at every meeting through the middle of next year.
Lydia, I just wonder what your thoughts are on the bond market action since the Federal Reserve reduced interest rates by 50 basis points. This big move higher we've seen in 10-year yields. What do you think that represents? What do you think is behind it?
Yeah, I mean, you've discussed on the show a lot of these factors that are behind this move. I do think that the upside surprise we've seen in the economic data over the past few weeks on the labor front, on the inflation front, a little bit more stickiness. And then on the economic front, with the upside, the upward revision to the personal income data. So all of that, the fact that we have a more favorable economic backdrop and a more positive growth picture, I think has been kind of, a key factor behind some of the moves that we've seen in the bond market.
Lydia, appreciate it. It's good to hear from you. Lydia Boussour there of EY, up 3 basis points now on a 2-year, 416 on 10s, close to 432. With us now is Mona Mahajan of Edward Jones. Mona, yields are higher, many people argue, for good reasons. For good news. We've had upside surprise after upside surprise from the economic data. And with that in mind, equities have held in there pretty well. Do you think we're entering into a zone where the 2-year above 410, the 10-year above 430 becomes a problem for stocks?
Yeah, look, John, and thanks for having me. We do think some sectors in the stock market will face a little bit of headwinds because yields have been stubbornly high, despite the fact that the Fed is likely to embark on at least a modest rate cutting cycle here. And I think we've started to see a bit of that cyclical part of the market, the value part of the market, certainly interest rate sensitive sectors like real estate, even areas like utilities and parts of financials have started to move sideways and move lower because we've had this rapid move higher in the interest rate picture. I think for that broadening of market leadership theme to really play out, we needed to see a Fed rate cutting cycle, but yields moving lower, in addition to earnings growth expanding, which, by the way, we think that part of the story is intact.
Let's talk about the earnings then. Alphabet after the closing bell. How high is the bar for big tech? We'll hear from Alphabet and 4 of the other Mag 7 names through the week, with Apple as well on Thursday. Just how high is the bar for these names?
Yeah, look, the good news is mega cap tech has taken a breather for the last quarter and probably since the second half of this year. So the bar has been probably brought a little bit lower. And for Q3 overall, the expectation coming into the quarter was for a 4.1% growth rate. Now we're actually trending, and we're early days still, about a third of the companies have reported, but we're trending below that 4.1%. So it'll be interesting to see if tech is a driver of earnings growth and is the driver of the upside surprises we might get this quarter, or it continues to be in line with the rest of the market and numbers come in line and slightly below what we're expecting for Q3. But more broadly, we'd say tech, after taking such a breather, could actually be part of the basket that investors are looking for as we head into 2025. If the Fed rate cutting cycle is more shallow than expected, if yields are higher, it's still an area that provides outsized growth in an environment of high yields and potentially growth that is moderating in the U.S. economy.
So if big tech doesn't clear this bar this week, do you think that could potentially be a buying opportunity?
Yeah, certainly we think after, the breather it's taken since the second half of the year, if we do start to get more volatility in this quarter, we do think, as we are headed towards that election day, we typically do see pre-election stock market volatility. We've seen it more in the bond market this time around. But if big tech does show a volatility after earnings reports this quarter, we certainly think there could be opportunities there, especially if you perhaps haven't participated fully in your kind of AI tech part of your portfolio. We still continue to like that market broadening theme. And we think there's opportunities ahead, especially as this yield move has moved very far, very fast, and could provide some opportunities as well.
So this election impact and volatility, you say we're seeing it play out in the bond market. Do you think that the market is properly pricing in the U.S. election outcome and this idea of a Trump sweep?
I think certainly the yields, as many people have noted, have been a combination of factors. It's certainly that economic data has surprised nicely to the upside. And this idea that we're getting a soft landing has almost transitioned to the idea that we're getting maybe no landing. Atlanta Fed GDP now is still looking at over 3% growth for this quarter. So certainly not even close to kind of that 1.5% to 2% trend growth. We're looking at an economy that is holding up quite well. And that in itself probably has sparked a repricing of the Fed rate cuts. We're seeing in the markets are now pricing in about a 3.75% terminal rate versus 3% just a few weeks ago. But the other part of the story, to your point, is we have an election on the horizon, and really either side of the aisle, neither of them have really taken a disciplined approach in terms of fiscal, reining in the deficits and fiscal spending, or on the tax side as well. So this idea that markets are pricing in deficits that may be creeping higher, grinding higher, in combination with an economy that's holding up quite well, is really leading to this move in the yield market, which is quite interesting, and certainly having much more of an impact versus what we're seeing in a pretty steady equity market.
Mona, take a listen to this. It came from Ian Lincoln of BMO in the last 24 hours. He said, "We struggle to come up with a compelling reason to challenge the prudence of stepping back from high conviction trades, as the next 2 weeks could very easily redefine the macro narrative." Mona, do you believe that next week, and the election in particular, has the potential to redefine the macro environment, the macro narrative?
Yeah, look, enacting real policy change, we know takes time. So despite the rhetoric, first of all, we think, checks and balances remain in place on whoever gets into that presidential seat. Probably that means some of the more extreme proposals are going to have more difficulty being passed. And so the real changes on the macro narrative will come around areas like taxes, perhaps on the tariff front, and maybe in terms of even immigration policy longer term. But again, these don't happen immediately. And so the near-term macro narrative will really still be driven by the fundamentals. Is the Fed cutting rates? Is inflation cooperating? And is the economy holding up? And the overall backdrop and the overall underpinnings of this bull market have really been a Fed that is cutting rates in an environment where we are not entering an imminent recession. And we know historically that has been good for stock markets and financial assets broadly. And we think, we've had a very strong run. The bull market's up almost 60% since October of 2022. Could we see a little bit of moderation in that pace? Absolutely. But we do think any periods of volatility we can still lean into because of those fundamentals that remain intact.
Certainly been bad for bonds, that's for sure, over the last month. Mona, appreciate your time as always. Mona Mahajan there of Edward Jones. Earlier on this morning, we had David Malpass, the former World Bank president, around the table with us. Asked him a very simple question to start that conversation. How much daylight is there? How big is the gap between campaign promises right now and legislative reality? And he just said one word: huge. Huge. It's really hard to get some of the things done that they're promising on the campaign trail.
Well, if you want legislative promises that things you actually think can get done, that might not get you elected, which is why you have basically spaghetti thrown at the wall when it comes to potential tax cuts. Any sort of American might be able to see whether it's no tax on tips or potentially no tax on Social Security benefits. Regardless, and I think Mona put this well, both camps will be spending more. And maybe that's what the bond market's picking up. Less so a Trump sweep, but just It's an election. Things are going to be shaking up in Washington, D.C. And guess what? No one cares about the deficit.
That's one warning. Here's another. This came from Citi's Global Equity Strategy team just yesterday, I believe. Indicated that Trump trades have rallied. We're all aware of that. Long the dollar, short bonds, long the US versus the rest of the world in equities. And the recent price action implies a less favourable setup for Trump trades heading into November 5th. Goes on to say, with room for rotation should Harris prevail. And I've seen that last note from a few people on the South side over the last few days. That's for sure, given this run-up we've seen in yields and the strength we've seen in the US dollar over the last month or so. Equity futures on the S&P 500 this morning, just a little bit softer going into the opening bell, about 44 minutes away. With an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Croc shares falling 13% pre-market. The shoemaker said it expects 2024 sales to grow at 3%. That is at the low end of their prior guidance. Crocs had seen a resurgence in the last few years following a strategic move to target teens with endorsements from celebrities like Justin Bieber and Post Malone. But now the company has run into trouble in U.S. schools that are banning them due to safety concerns. The top prosecutor in Philadelphia is suing Elon Musk and his Trump super PAC. District Attorney Larry Krasner says Musk's daily $1 million giveaway is an illegal scheme to influence the election. The giveaway, which is already under scrutiny by the Justice Department, purports to randomly reward voters in 7 swing states who sign a petition from the PAC. Musk's allies have argued that the giveaway awards people for signing a petition, not for supporting Trump. The Dodgers are 1 game away from winning the World Series. They beat the Yankees 4-2 last night and take the 3-0 lead into tonight's Game 4 in the Bronx. If the Dodgers win tonight, it would be the first World Series sweep since 2012. The Yankees are hoping, though, to be the first team in baseball history to come back from a 3-0 deficit in the Fall Classic. And that's your brief, John.
Danny, thank you. Thanks for this morning, and thanks for that. Someone in the control room trolling Anne-Marie this morning. I think we've done that story 3 times.
Yeah.
Once every hour.
And why didn't we do 3 times when they were winning?
We gave updates, regular updates. What are you talking about?
It was once per the 3 hours.
Can you avoid the sweep?
I hope so.
Okay. How much cheaper are the tickets now?
The tickets are a lot cheaper. I'm considering going tonight.
All right. Up next on the programme, we'll set you up for the day ahead. We'll catch up with Mike McKee. Some really important jobs data coming a little bit later. From New York, this is Bloomberg. The opening bell is about 40 minutes away. Let's call it 39. Equity futures on the S&P down by 0.2%. Look at this move in bond yields. Up 4 basis points now, 4.32 on a US 10-year. Here's the trading diary, the calendar for the week ahead. Today, we'll get JOLTS data, job openings, plus Google earnings after the closing bell Wednesday. Initial GDP data and earnings from Meta and from Microsoft. On Thursday, a rate decision from the BOJ, and in the US, another round of jobless claims and core PCE, plus earnings from Apple, Amazon and Intel. On Friday, October payrolls plus PMI data, and on Monday, already looking ahead to Monday and next week, you'll get some durable goods data, but that's pointless to look at because you know what happens next week. It's election day, a week away, then 2 days later, a Federal Reserve has got to somehow make a decision. Mike McKee's with us. He'll be in the room in that news conference. Mike, good morning to you. Can you imagine how many questions there'll be about the US election that'll get ignored in that news conference?
I'll give you one question right now. 8:30 Friday morning, we get the jobs numbers. Will we know who the president is by the time we get the jobs numbers? That's, it'll still be hanging over everybody for days.
Without a doubt. Now, for you next week, this Friday, payrolls this Friday, then the election on Tuesday, for the Federal Reserve 2 days later. How noisy is that data going to be from the payrolls data?
Well, there's a good chance that the payrolls data is pretty noisy because we've got the ongoing Boeing strike, and it's been on long enough now that it may spread to other industries, suppliers of Boeing, people who, have snack bars near Boeing, that kind of thing. And also, we have the hurricane issue. We don't know how many people are going to be out of work because of the 2 hurricanes. We saw a 1-week spike in jobless claims, and then it kind of went back down. So is it going to be bad or not? Bloomberg Economics thinks we could have a negative 10,000 print, and there is one estimate for 180,000 jobs created. I think probably the consensus of about 100,000, 110,000 is going to be the way to bet, but we just don't know.
What is, though, the possibility, the ramifications if we were to get a -10 print? That will certainly help out the Fed, but how bad is that going into a presidential election?
Well, I think you put your finger on it because it's not going to matter to the Fed. They will look through it. That'll be the headline number. The jobless claims number won't be affected by that. I mean, the unemployment rate won't be affected by that. So the question is, how do the headlines play it and how do the campaigns play it? Obviously, you're going to see Donald Trump emphasize the weak job creation. You're going to see Kamala Harris emphasize the unemployment rate. Does it really get through to people in a way that will make a difference? Right now, everything that happens is being put through that lens of, does this make a difference in the election?
True. Plus, already 50 million Americans have already gone out and vote. And many of them will probably go out and vote even before we get that non-farm payrolls report. You say the Fed will look through a weak print. Can they look through a strong print?
Yes, because they're on a path to cut 25 anyway. So a strong print would probably just mean that they stick with 25. They don't do 50. And because this is coming in an unusual situation, November is probably going to remain on track. They won't have enough details about what happened in the jobs numbers, and we won't know who's going to be president. So they probably go with a 25 this time, and then December becomes the big question.
We've got about a minute left, which is a minute too long for some baseball wisdom from a Red Sox fan, if you're Anne-Marie. Do you want to share some?
Did you see the map of the country and who supports whom? It was like Southern California for the Dodgers and Massachusetts. And the Yankees had New York and Florida. So the rest of the country,
Can they avoid a sweep?
Of course
Probably. Well, they could avoid a sweep, but can they win the World Series? That's going to be really tough. And as Red Sox fans would point out, only one team in a 7-game playoff has ever come back from 3-0.
Why are we ending on this? Who invited this?
This is baseball wisdom. Knows more about the sport than I do, that's for sure. Michael McKee, thank you, sir. Appreciate it. Going to the game a little bit later, Anne-Marie with tickets on discount in the Bronx. 50% off? What's the discount look like?
The discount's pretty big. Not for right behind home plate. Those come a few thousand off, but you can get actually some decent seats now a lot cheaper than if you bought them when they clinched the American League title.
OK, good luck to the Yankees a little bit later. Coming up tomorrow, Katrina Dudley of Franklin Templeton, Scott Devitt of Wedbush, Jack Caffrey of JP Morgan, Emily Rowland of John Hancock. Lisa will be back. As for Anne-Marie, I'm not so sure. From New York, this is Bloomberg.